Good morning. It is Thursday, December 15th here in New York City and a lot of other places around the world. This is Yahoo Finance Live. I'm Brad Smith alongside Julie Hyman and Brian Sazi. Let's get straight to the top things that you need to know as the clock hits 9 a.m. Futures sliding this morning after the Federal Reserve signaled plans to raise rates through the spring, shutting down investor hopes that they might slow down the pace of hikes over at the Fed.
Yeah, they might slow it, but they are not done. Futures are also reacting to some ugly retail sales numbers we got this morning, down 0.6% in November. Estimates were for a drop of 0.2%.
And it all means one thing, to be or not to be in a recession. But there is one big question that matters just as much as that, according to our first guest. Julian Emanuel from Evercore ISI will join us with his 2023 outlook in just a bit. But first, let's go over to our friend Jolly Julie over at the Interactive.
I guess I have the
very
holiday
festive today.
jolliness today. Let's take a look at what's going on with the S&P futures, because indeed we did already see them selling off, and then a little bit of acceleration of selling into the retail sales numbers. So that further slide kind of started even before the retail sales numbers came out and came in disappointing. We'll talk more about that in just a bit. But of course, you see that reflected across the board for futures, more so for Nasdaq 100 futures. That is something we've been talking about regularly here, that large cap tech has been hit more than the others by the perception that rates are going higher. We also got, by the way, just a quick look, if we could, at the euro, which is trading lower this morning, but bouncing around quite a bit. That central bank also raising interest rates, and we've heard from a lot of central banks today, which we'll also talk about in just a bit. Here in the U.S., the 10-year note, we are seeing the yield going down here, even as the Fed says it's going to be continuing with its interest rate increase cycle, perhaps more than the market wants. And there does seem to be quite a disconnect between the market and the Federal Reserve, what it is saying and what the market thinks it's actually going to do. We are going to talk more about all of this, Brad.
That's right. All right. So let's continue this conversation in terms of some of the economic data that we're seeing come out this morning. U.S. retail sales fell more than expected in November. It declined 0.6% month over month. This is the biggest monthly drop in nearly a year. A possible warning sign for the economy as the Fed continues to raise rates here. And looking across some of the key segments here, especially as we've been continuing to watch in those discretionary portions of the consumer spending environment, where we do see some continued weakness and where consumers are continuing to push back on prices. And that continues to be the case. I mean, electronics, you saw that decline in the most recent month. And then additionally, you also looked across some of the other core necessities spending categories too. And we still did see some softness there, even though we did see a rise in grocery stores of about 0.8% here recently.
First thing I did, guys, off of this report is I went to check some of the pre-market action in stocks like Macy's and Abercrombie & Fitch. Of course, both of those stocks are down. The main takeaway from this report is that the retail season may be coming in worse than expected. And then what does that mean for retailers that entered this holiday season with high levels of inventory? Perhaps they're going to have to more aggressively mark down this stuff that clearly has not sold like they thought. What does that mean for margins? What does that mean for fourth quarter profits? And then also, when do these warnings start to come from the sector? Do they happen the week after Christmas, which is what usually happens? You start to hear a lot from these retail companies.
Now, one important thing to note about this report is it's not inflation adjusted. So inflation, as we learned last month, was rising at a slower rate, but it was still rising. And so to see outright drops for retail sales and for many of these categories, even with increases in price, is quite telling and interesting. Now, you mentioned what's going on with some of the department store retailers this morning. Department stores down 2.9% in terms of their sales in the month. In the holiday season, department stores down 2.9%. Non-store retailers, a.k.a. Amazon and Pure Play, but a lot of that number is Amazon, down 0.9%. So this is really interesting. We keep talking about how is this holiday season going to be. This gives us a hint of what this holiday season is going to be.
Yeah, and I'm glad that we showed the stock chart there a moment ago for Dick's, or not the chart, but at least a board of some of the biggest retailers, because within the sporting goods, hobby, and musical instrument bookstores, you saw some declines come in at about 0.6%. And you think about what this means for selling through even some of the sports equipment that perhaps isn't moving out of the stores as quickly as Dick's would hope, or even in their subsidiaries in Golf Galaxy. But what this also means for just moving through that inventory, how that pass-through also means perhaps even more of a headwind for a Peloton out there too, if you see more of that sporting equipment just kind of sitting in some of the square footage at those stores. numbers too.
And sort of related to that, by the way, just a more minor data point that I just want to mention because it was so bad. Empire Manufacturing, negative 11.2 was the reading for December. So that's a pretty current number. Negative 1 is what economists were estimating. So yet another negative.
Who said it was going to be a slow November, or December, I should say. December. It has been a full-on data explosion here. All right, the Federal Reserve raised short-term interest rates by 0.5 percentage point to its highest level in 15 years. This move, an indication that the fight against inflation is not yet over. Let's bring in Yahoo Finance Fed correspondent Jen Schomburger. Jen, saw you in there in the media section yesterday. Got your question. What are some of your takeaways?
Good morning to you, Brian. Yeah, that's right. The Federal Reserve slowing down the pace of rate hikes, raising its benchmark interest rate by 0.5 percentage point to the highest level since December 2007. That brings the Fed funds rate up to a range of 4.25% to 4.5%. Officials raised their estimates for the peak of their short-term rate by 50 basis points to 5.1%. That's about 25 basis points higher than what the market was expecting. And that's just the median. 7 officials see rates moving higher than that 5.1% level, with 5 projecting rates could move as high as 5.25%, and 2 projecting rates could move as high as 5.6%. Fed Chair Powell struck a hawkish tone in the press conference, saying that the committee is not at a sufficiently restrictive policy stance yet, and that it's possible officials could raise estimates for rates even higher if inflation continues to be sticky. Take a listen.
I can't tell you confidently that we won't move up our estimate of the peak rate again at the next SEP. I don't know what we'll do. It will depend on future data.
Powell said inflation data in October and November pointing to that cooler CPI numbers are a welcome reduction, but that it will take substantially more evidence to gain confidence inflation is on a sustained downward path. Powell said he wouldn't see the Fed considering cutting rates unless the central bank is confident inflation is coming down. The Fed chair noted that reducing inflation will likely require a sustained period of below-trend growth. The Fed lowered its growth forecast. It now expects just 0.5% of growth next year and about 1.6% in 2024. December's moves cap an historic year for the Fed that saw the central bank raise rates at the fastest pace since the 1980s to tame stubborn inflation that reached a 4-decade high. After holding rates at near zero since the beginning of the pandemic, the Fed moved in March to raise rates, ultimately raising rates by 4.25 percentage points this year, including an unprecedented 4 75 basis point hikes in a row. Fed Chair Powell's commitment to, quote, keep at it until the job is done earned him comparisons to former Fed Chair Paul Volcker. Powell repeatedly reinforced that the Fed's resolve to quell inflation wouldn't be without pain. Now, next year will bring continued rate hikes, though at a slower pace. Powell did not tip his hand, of course, as to whether the Fed would slow down the pace of rate hikes even further to 25 basis points at its February meeting. Back to you.
Jen, of course, it's not only the U.S. Central Bank that has been busy in the past 24 hours. We heard from the ECB, the Bank of England, a lot of tightening out there.
Yeah, Julie, absolutely. Inflation is very much a global story, and both the Bank of England and the European Central Bank sort of mirroring the Federal Reserve's moves, raising their benchmark interest rates by 0.5 percentage point and stepping down just as the Fed did. They, too, have a balancing act of trying to cool inflation while also making sure that they're not crashing their economies, as there are signs of slowing economic growth over there as well.
Thanks, Jen. Appreciate it. And of course, there's been a lot of reaction to this. As I said, there's a disconnect between the Fed and the market here because the market doesn't think the Fed is going to be as aggressive as the Fed is signaling, right? And if you look at some of the economic data this morning, that's perhaps why, we had been in a period of time where bad economic news was good news for the market because they would extrapolate that the Fed is going to be easier with its policy. But because the Fed has been so resolute and Jay Powell's been so resolute in his conviction that the Fed needs to keep going, now maybe economic news that's bad is bad again because he's going to keep raising anyway.
Right. And one of the kind of core clues that we could take away from what he said yesterday was we continue to anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy sufficiently restrictive to return to that 2% inflation over time. So net takeaway there, they're not going to stop until they ultimately see evidence of a trend that's going to remain in place. And that doesn't mean that we may see a pivot anytime soon.
No, this was Jay the Jackhammer, and we talked about this yesterday, setting this up, that he was going to push back on a lot of this easing in the markets, and I think he did. And then also, you could see that within where the Fed sees rates next year, well over 5%. I don't think the market was expecting that. They were expecting, I think, a 25 basis point rate increase at that February meeting. It doesn't look like they were going to get it. And to that point, I have a story right now. I'm going to plug myself here on the Yahoo Finance homepage.
That's weird.
Right? Go figure. Goldman Sachs out this morning, Chief Economist Jan Hatzius is saying he's not looking for any rate cuts next year. So really an interesting take by Jan and his team over there.
Yeah, he's certainly not the only one, I don't think, who says that. Let's talk more about the latest Fed moves and the retail sales data and the effect it's all having on the market. Evercore ISI Senior Managing Director Julian Emanuel is with us. Julian, it's great to see you. What do you make of the Fed's sort of credibility right now? Because the market doesn't seem to be taking Jay Powell at his word.
Well, look, the credibility, they tried to double down on the credibility. And the fact is the signal of raising their projection for core PCE inflation from 3.1 to 3.5 for the end of next year is telling the market that they are not going to cut rates under virtually any circumstance, with the exception of a very, very severe downturn that also brings down inflation faster than the rate at which it has started to decline. But that's by no means their base case. So Jay Powell wants to be taken at his word. And I think when you look at the way markets have traded this week and the way they are trading this morning, they are taking him at his word in that respect.
And Julian, to that point, I see this market action to the close yesterday after the Fed. I see it here this morning, ugly. And my first thought is the market hasn't bottomed yet.
We don't think it has. Basically, again, if you go back to those summary of economic projections, they raised the unemployment rate for end of 2023 to 4.6%. The low earlier this year was 3.5%. That kind of rise, 3.5 to 4.6, we don't even need to get to 4.6, but even to approximate that kind of rise, you have always triggered a recession. And frankly, the history of bear markets is such that when you think about it in the context of that October low that we had, no bear market has ever bottomed before the recession started.
So what's your target? Where do you believe that the range is that we should be tracking for a market to potentially bottom out even prior to us experiencing the full breadth of or the depth of a recession?
So we don't necessarily need to see the full breadth and depth of the recession. We need to see the start of it. So part of the issue with 2022 is that when you think about both earnings and the economic recession, we've been forecasting it all along. We know it's going to happen. The Fed confirms to us yesterday that it is very likely to happen, but yet it still hasn't arrived. And with that arrival, we would expect to see what we would call more cathartic capitulation type action in the market. As poor a year as this has been for stocks, there has really been very little emotion the entire way down. We think that will end sometime in the first half of the year, likely making a new low for the S&P 500. But the ray of sunshine here is that kind of low is going to set the launch pad for, in fact, what we think will be a year where stocks finish higher than where they are now.
And I guess most of that would have to happen in the second half of the year if indeed the timing of what you're talking about, right, of when the recession occurs, when stocks tend to bottom, et cetera, that's when you would start to see things take off more.
That's right, Julie. Again, we've been waiting. It's like, part of the bullish case is that Godot is never going to arrive, meaning the recession gets, kicked out into late 23 or early 24, and that to us is a case whereby the stock market just could continue to grind higher until you get closer. That's kind of what happened during the bear market of 2000 to 02, is that you had the initial sell-off and then a rally, and then 2001 was the really brutal downside. But for us, we'd actually prefer to see the forecasts crystallize into reality, which frankly, when you think about it within the context of the fact that the public has become a seller of stocks in the last several weeks, if we see more selling urgency, that's the kind of condition when the recession arrives that creates really high risk reward buying opportunities for patient, disciplined, long-term investing.
Let's talk about some of those opportunities quickly. And we're actually going to be talking to an energy trader later in the show. But I got to say, it stood out to me that you like a couple of energy names, in particular in your latest note, ExxonMobil, Schlumberger. You wrote actually a bigger note about energy names. Why do you think those guys are going to be able to perform? Because they have way outperformed oil prices this year.
So this is where we think the reasoning is faulty. The comparison of the stocks to the oil price is just, it's misplaced. If it weren't misplaced, we would have never bought an oil stock again in 2020 when the price of WTI turned negative. The bottom line here is that when you think about the earnings of the S&P 500 as a whole, energy, even with muted expectations for earnings next year, is going to represent 9% of the index's earnings. And it's only 5% of the weighting in the S&P 500. And when you look at the valuations in the energy sector broadly, they are already discounting the recession multiple-wise that the rest of the S&P 500 has yet to fully discount.
A lot to keep tabs on there. Thank you so much for joining us this morning. Evercore ISI Senior Managing Director of Equity, Julian Manuel. Thanks so much, and happy holidays to you as well.
Thank you. Happy holidays to you.
Guys, coming up, Elon Musk is revving up his selling of Tesla shares. We've got the details for you on the other side. Turmoil for Tesla. Recent filings indicating CEO Elon Musk has sold over 20 million shares of the electric automaker. This in addition to other large sales of stock in November, August, and April. He now sold roughly $23 billion in Tesla shares. Joining us with more, we've got Yahoo Finance's Pras Subramanian. Pras, my goodness, he's just going to keep selling, it seems like, to finance this deal.
Yeah, I mean, it sort of explains what's going on with Tesla's stock this week, right? Down 10% in the past 5 days, 55% this year. But, recently we just saw that filing, 22 million shares sold Monday through Wednesday, really weighing on the stock, ostensibly to fund his Twitter purchase. But we don't really not necessarily know what he's using that money for. But the bottom line is, like I said, Brad, 23 billion since April, 40 billion in stock sales this year. And he's also lost that crown of richest person in the world. So that's not kind of a little knock there for him. But the big story here is investors are not happy about this. These sales are sinking the stock at the worst time, at a time of deep concern. We have slowing demand, high prices hitting a toll, macro headwinds hitting the auto industry, and of course, new competition like GM, Ford, and Volkswagen. So really the last thing that Tesla investors want to see right now is more stock sales from Elon.
And Pras, what is interesting, we've seen one or two downgrades, but by and large, you're still seeing the street and the analysts that cover Tesla maintain confidence in this company. You find that surprising?
I think we're seeing a combination of both from, Morgan Stanley and also Goldman Sachs recently about how they're short-term concerned, but long-term, the long-term bullish play is still there. They're convinced that the battery tech, new platforms coming out, and just overall Tesla's kind of technological tech superiority there is better than the OEMs at this point. So they're still kind of bullish on that long-term story, but the short-term thing is Musk's sort of distraction. How does Tesla go back and refocus itself on its sort of story on its EV transformation as opposed to what Musk is doing with Twitter?
Yeah, obviously a lot more still to consider for investors. Just thank you so much, Pras. Just one quick note I wanted to make, by the way. Even on the peak selling day for Musk, 11 million shares that he sold, according to filings. The total volume for Tesla that day was 175 million shares. So certainly you cannot blame just that big block trade for the decline in the stock that we have been seeing lately, or the block trades. Let's continue the conversation, though, by focusing on another aspect of Tesla's turmoil, renewed interest in the automaker by everyone from retail investors to Cathie Wood. Some of them seeing this as a good time to buy. Other side of the trade, right? If he's selling, somebody's buying. Yeah, you find us Alexandra Semenova has been looking at that side of the story.
Well, exactly, Julie. It has been a rough month for Tesla, but you know who is not shaken by what's been going on? None other than ARK Invest Cathie Wood, who continues to stand in Elon Musk's corner despite all that is going on with Twitter and Tesla. We know that she's been a longtime Tesla bull and hasn't been phased at all since his acquisition of Twitter. Yesterday was the perfect example of her continued conviction in Tesla. According to a transaction report that hit my inbox after the close, she snapped up nearly 75,000 shares valued at around $11.7 million based on yesterday's closing price. A hefty amount of that, of course, went to her flagship ARK fund. And it did come just before we learned about Musk's offloading of Tesla shares that rattled investors. But I don't imagine that things would be any different for Wood had that report come out before her purchases. We've seen Elon Musk sell off Tesla before, and that hasn't really phased her long-term outlook for Tesla. Julie, you spoke to her last week. She said that she continues to believe in Musk in the future, and as she said before, he is ARK's renaissance man.
Well, there's other believers here too, Alexandra, and that is the retail investor that might be looking at this decline in Tesla shares as a once-in-a-lifetime opportunity.
Exactly. Individual investors are also buying up Tesla stock. That's been their favorite for a while. In fact, retail inflows have actually been lower this month compared to the monthly average, but they haven't changed their interest in Tesla at all. Net retail purchases of Tesla reached $610 million across the 5 trading sessions ended Tuesday. That's according to the latest available data, probably even higher today. And despite a slowdown in allocations, retail investors continue to focus on their same favorite trades. That is Tesla, technology stocks, energy stocks, and occasionally buying the dip. They bought the dip across airline stocks earlier this week. And an interesting point to make here too is that even as institutional interest in Tesla, falls out of favor as they de-risk and rotate out of Tesla, the retail purchases of Tesla have actually helped offset some of those losses. So it would be even lower if it weren't for those individual investors who believe in Elon Musk.
Right, and of course you can catch Alex's whole story on the Yahoo Finance homepage now. Alexandra Semenova, thanks so much, appreciate it.
Thanks, Brian.
All right, straight ahead, Warner Brothers Discovery warns big on more asset impairments as part of its deal for Warner Media. We have those very large numbers and the opening bell next. Welcome back. We're a few minutes away from the opening bell on Wall Street. So let's hit a few hot tickers on the Yahoo Finance platform. Shares of Roblox in focus as the gaming company announced November key metrics headlined by daily active user growth up 15% year over year. So you're probably wondering why in the world is the stock down close to 11% in the pre-market. And I do think the stock is trading off this estimated revenue for the month, which was only up 1 to 3%. When you're Roblox and you continue to be priced for perfection from a stock standpoint, that growth is just not going to cut it.
Yeah, especially when the hours engaged are up 10% year over year, but that's not really passing through to the revenue that you're expecting to get. And then the bookings additionally up 5 to 7% year over year, between 222 million and 225 million is what they're estimating as of right now. But again, this has been an embattled stock for exactly how investors are looking through both the bookings, the hours spent, the time spent, and how that converts into money spent on Roblox as well. And if there is more tightening of that consumer discretionary dollars, even within a gaming environment, Roblox could be one of those companies that gets rocked by it.
Yeah, I mean, to still see 15% year-over-year growth in daily active users, I mean, sort of on an absolute basis, that's not bad in this environment. However, the street has been really laser focused on those bookings numbers that have been a little bit disappointing. So the bookings for November, the company is saying, will be $222 to $225 million. And so that perhaps is what investors are looking at with this.
You're my guy with Roblox, Julie. Are your kids still on it and using it as much as they were?
So no is the short answer. They have diversified. They're on something called Poki. I don't really understand.
Like for Pokemon?
No.
Oh.
P-O-K-I. It's another platform that I think people program on. There's a little bit of Fortnite in there because I finally relented on the Fortnite front. But they also just watch Netflix and
you're a forward-looking indicator on Roblox shares. Very nice.
Maybe I am.
Very nice. The Jolly Julie indicator.
I don't know if they are typical or not. Like they're not on TikTok, so they're not typical in that way, I guess.
They shouldn't be on TikTok yet.
No, I know, but some of their peers certainly are.
How'd they sell you on Fortnite? I mean, that's.
I don't even know.
We're on live TV.
Honestly,
We don't have to share this. It's okay. We'll take it offline.
Heavy negotiations.
Just curious.
Yeah.
Yeah, there were some discussions. We watched him play a little bit.
No Call of Duty, right?
No Call of Duty. Come on.
Just making sure.
Come on.
My parents would have made me make a PowerPoint presentation as well.
Yeah, I didn't.
My parents were like, what the hell? Play whatever you want, Brian. Go right ahead. We should explain a lot now.
Why don't know. They seem pretty strict when you've told us other stories. Well, we'll dig into this later. Anyway, we've got the opening bell here on Wall Street. Lanvin Group snuck up on us as a SPAC deal here, closing it out before the end of the year. Lanvin, of course, the fashion company with French heritage that actually has a Chinese owner, I believe now, as it goes public here. Owns not just its namesake brand, but brands like Wolford, St. John's Knits as well. I'm sure you're...
Oui.
Oui?
Yes? Is it yes?
That
Yes.
is yes.
That was me agreeing.
I wasn't sure if you were saying
I was
oui,
trying to like,
which
you
is
know
another
French. You know
discussion entirely.
French. You know French.
I know French,
Yeah.
yes. We are seeing stocks sell off as we get underway here this morning. And I'm going to send it over to Brad at the Interactive. Oui.
A lot of rouge on the screen, I believe.
Yes, very good, very good.
Dow Jones Industrial Average right now, that's in the red by about 1%. You're seeing that lower out of the gate. Let's populate this chart for you, give you at least something to look at here. Over the past 2 days, we're down on the Nasdaq by a little more than 2%. Right now, we are down by about 1.4% early in today's trading activity for the tech-heavy average. Also checking in on the S&P 500, you're seeing that down a little bit more than 1% right now, too. That's lower by about 1.2%. Past 2 days, that's down by about 1.8%. So let's take a look at some of the sector activity as we have officially gotten today's trading session underway here. And yeah, there we go. Okay, a little glitchity glitch, but that's all right. Now we're on the right screen. XLB, that's the biggest laggard as of right now. That's not what the B stands for, but materials, you're seeing that lower by about 1.7%. And utilities, that's also down by about 1.4%, at least the least of the decliners there on a day where all 11 S&P 500 sectors have opened lower as of right now. And then additionally checking in on the Nasdaq Composite, let's just give you a quick view of some red on the screen. A lot of red and very few areas of green to be found. It looks like Baidu, Moderna, Datadog, some of the only bright spots in the Nasdaq right now, but mega cap tech really getting hit hard here out of the gate right now.
It is interesting that Tesla is down less than the rest of tech today after yesterday, or on Tuesday it was, a lot of the rest of the Nasdaq 100 was green and Tesla was red. So now that, maybe there's, not that they're done selling, but certainly we've seen heavy selling in Tesla over, as you can see, the past 5 days down 10%. Yeah. And now down, but not down as much.
Was that a Tesla? That wasn't a Tesla prediction, right? I just want to clarify. Because you don't make predictions.
No, that
okay, I just want to make sure.
Prediction.
Okay, just one, okay.
I don't know how you would even mistake
that's just
that
me.
for a
That's
Tesla
how my brain's
prediction.
working today. Okay, just want to make sure.
Let's talk about another stock that's on the move this morning. That is Warner Brothers Discovery, still feeling the financial pain from its Warner Media deal. The company raised its projected costs for restructuring charges. It's scrapping planned content by $1 billion here. The company says pre-tax restructuring charges will be as much as $5.3 billion through 2024. That's $1 billion higher than its prior prediction. And it just keeps sort of paying the piper here.
Yeah, and here's my CFA level analysis. They just paid too much for the asset. They underestimated the future cash flow and potential of this business. And I wouldn't be surprised if we're sitting here next year having the same discussion of more asset write-downs. They just paid too much for a business that had a lot of bloated costs, as you continue to see them cutting a lot of costs internally.
Yeah, and I mean, this, in what they've kind of signaled about the future of the not just content space, but overall streaming and their shift to streaming, how much they've spent to try and play in streaming, but then at the same time trying to build up and differentiate their content versus other platforms. Other platforms have had a massive head start even prior to this deal fully coming together and being consummated so that they could have that operational integration and create some type of synergies, but some of those synergies have led to mass layoffs that we've already seen as well come forward. And so with that in mind, it's really just a question of what are the titles that are going to get people to stay on the platforms and ultimately, as we were looking at, oh my gosh, what was his face over there?
Guy Fieri.
Was that Barefoot Contessa? Big fan. I mean, her recipes are fire. Oh.
I do have one of her cookbooks.
They're amazing.
Ina Garten.
OG. She's an OG.
I do not have any Guy Fieri cookbooks. Let's talk about another one here. Shares of Snap, snares of Shap, are in focus following a downgrade from Jefferies from buy to hold, a $10 price target, although that's above where they are now, citing rising competition and macro headwinds that could limit the company's revenue growth. You see the shares right now down 9%. There's a transfer of coverage here to James Heaney, who's now covering the stock, and says that the street is over overly optimistic on digital advertising growth in 23 and 24, which is interesting because obviously we've seen a re-rating of the whole sector. Anyone that's exposed to digital advertising, he's effectively saying you've not come down enough.
Yeah, Snap shares down, Julie, 82% year to date. So interesting to see this call now.
Yes.
Well, I mean, yeah, and they're saying that they believe Snap is going to continue to face several headwinds, including the iOS 14.5 privacy changes, worsening macro picture, intense competition. Many of the factors they say are well understood, but it's really just the fact that some of the estimates, as you mentioned, still appear too optimistic, even at this point for the brand of Ghostface Chilla.
But also no catalyst. There's analysts noting they don't really see any catalyst to get the stock really out of the doldrums, which is a major red flag. That's why I think you're seeing the sell-off just accelerate today.
Well, we're also seeing more people, even when there are some of the tightening of consumer discretionary dollars, more people still are looking at social media to get their shopping inspiration, at least right now. But it's not necessarily Snap that they're going towards for that. And I think that's where the advertiser dollar flow through is starting to dry up for them, because if they're saying, okay, we can't just have a strategy for our marketing dollars that goes across every single platforms and saturates the consumer and the screen time that they have. It's really more of a question of, all right, what do they chop off in that? And Snap is probably.
Yeah, I mean, I'm not buying Lip Plumper off of Snap. It's just not going to happen.
No.
Not going to happen.
Are you buying it off of
I'm not buying
somewhere
anything
else?
off of Snap at all.
You're buying Lip Pumper off of
Well, I'm not telling
somewhere
you.
else?
I'm not telling you that right now.
All right, you can just slack us.
We're on TV, guys. What do you expect?
Also, let's take a look at shares of Lennar, the corporation this morning. They're down by about 3.25%. Ticker symbol LEN, moving lower this morning, despite topping earnings expectations. And the company issued a weak forecast for new home orders and rising amid some of the rising mortgage rates that we continue to discuss as well.
Yeah, it looks like the gross margin forecast in particular for the first quarter is what analysts are zeroing in on. That was 21%. And looking at some of the analyst commentary, that seems to be what the focus is on. Also over at Barclays, the analysts, they're saying the decline in average selling prices is going to be likely steeper than expected, which is something that would pressure those margins.
Here's how I cut the time on reading this report. I would say by 75%. So a couple ways I read it. First, deliveries, new orders down 15%, red flag. Backlog down 21%, red flag. And then food for thought, anytime you see the first quote by a CEO in an earnings release start like this, we are pleased to announce our fourth quarter results, which were consistent with our previously articulated strategies. It's usually a red flag that the rest of the earnings release is not going to be good.
In addition to the new order
And
decrease that you mentioned? Yeah, new orders down 15% as you were mentioning, but the dollar value of that decreased 24% to $5.5 billion as well. And so even with the new orders that are continuing to come in, but the overall decrease in that holistic figure, the amount that people are willing to spend for those new homes because of the financing structure being vastly different than it was last year and even during the pandemic, that's taking a hit on Lennar as well.
Yeah.
Everyone, coming up, Yahoo Finance's Jared Blickery is going to break down the latest market action following yesterday's rate hike. Welcome back, everyone. It's almost the end of 2022, and as the year comes to a close, we've been taking a look back at the top trending stocks this year with our own Jared Blickery. Jared, what you got for us today?
Apple yesterday, Amazon today, standing at number 6. That is our number 6 trending ticker of the year. And I just want to take a look at the stock movements and give some milestones that the stock and some of its sector action have accomplished this year. So here's a year-to-date chart. You can see it's down 46%. We're going to compare it to some of the other mega caps in just a minute. But it was in early March that retail consumer discretionary was really taking it on the chin. It was the first S&P 500 sector of 2022 to be down 20% or more. And then at these lows down here, again, XLY, consumer discretionary, where Amazon plays a huge part, is the first sector of the S&P 500 to be down 30% or more. And here we had a little bit of some consolidation. And this is when Amazon rises to Yahoo Finance's number 1 trending ticker. It's on a 1-week rolling basis. And that is the first time since before the pandemic. So the fact that Amazon was doing that at those lows, which were down about 40% at the time, really not the best look there. Now, in early November, at these lows, we had Amazon sinking below $1 trillion in market cap. That was the first time in over 2 years since April of 2020. You'd have to go to the depths of the pandemic. And finally here, a couple more stats. Amazon 52-week rolling returns falls to minus 50%. That is the biggest drop since November of 2008. But if you want to know how this stock fared in the prior bust, that would be the .com bust, lost about 80%. So pretty jaw-dropping returns there. Here is the mega caps year-to-date performance. Just want to show you Amazon situated right here, down 46%. As it compares to most of the other mega caps, it is quite more in the red than they are. Meta would be an example. Meta is down about 65%. Just want to show you now how the stock compares to some of its other retail competitors. This is again a year-to-date look here, and we can see kind of a mixed board. In fact, it's a clear story of have and have-nots. Amazon on the bottom row there, actually the 4th worst here, and you can see a trend. A lot of these are levered to the e-commerce space, whereas some of the winners up here are more of the traditional brick and mortar, some of them arguably consumer staples as well. So Amazon has been our number 6 trending ticker for a variety of reasons this year, not necessarily all of them good.
Very fitting to see Amazon there right next to Kohl's. Of course, they have that return partnership. Very interesting. I just couldn't help myself.
Yes,
Jared Blickery,
yes, thank you.
amazing analysis as always.
Usually can't.
Nope, can't. All right, after a while of stocks being a more popular search term than bonds, the tables have turned, points out our friend Liz Young over at SoFi. According to Google Trends, web search interest has been higher for bonds than stocks in the past several months, as you can see on that nifty chart. Straight ahead, we're still drilling into predictions for the oil market in 2023 after a wild year this year. More on all this next.
Oil prices have cooled recently, erasing their gains for 2022. But our next guest says the two key things that will determine the fate of crude in 2023, China demand recovery and Russian supply sustainability. CIBC Private Wealth U.S. Senior Equity Energy Trader, Rebecca Babin joins us now. I'm so used to saying equity, Rebecca. Thanks so much for being with us. Appreciate it. I want to talk about the China piece of the equation first, because we are now seeing China actually kind of open up even more abruptly than had been anticipated. So how is that, because it seems a little choppy, going to affect the picture as we get into next year?
So that's the big question, Julie. You totally nailed it. China reopening more quickly is a sentiment positive because it means we're obviously going to see demand increase. Demand has been compressed by an additional 1 million barrels from September due to China's most recent lockdowns. That's a huge number. 1 million barrels of demand loss equates to, back of the envelope, around $15 a barrel in crude, right? So if we bring that back, you're going to see a huge tailwind in the commodity. The reopening trade, however, is not going to be linear. And the sentiment lift we got when the reopening was initially announced in crude kind of fizzled last week on this idea that we may actually see demand get hit initially as cases spike and people decide to actually stay home because they don't want to get sick or because they are getting sick. This is going to be a positive trade in 2023 for China. The question is, how does it play out over the course of between now and then? And it's going to be choppy. I will say this, though, if you look at the high frequency data coming out of China right now, mobility data is actually increasing. And some of that sentiment shift we saw last week, I think, was an overreaction to potentially, oh my gosh, the hospitals are going to be overrun, et cetera, which we still may see. But right now, the high frequency data is showing some improvement on easing of some of the restrictions.
Rebecca, energy equities have outperformed massively this year when compared to pretty much any part of the market. And so what does that set up going into 2023?
That's a great question, and that's a battleground topic, as I would call it. There's so many people out there who are looking at energy outperformance, not only relative to the rest of equities, but relative to the commodity. They've outperformed the commodity by 30% in some cases, and saying, hey, have they already priced in the best case scenario coming out of China and Russian supply disruptions? And do they have the potential to continue to perform? And do they catch down to the commodity, or does the commodity catch up to equities? I would say this. I think it's going to be a harder trade in 2023, but I think it's a trade that can still work based on the fact that these companies are not making rash decisions about increasing production when crude rallies. They are less levered, they are more disciplined, and they are super focused on returning cash to shareholders. Now, obviously, there is execution risk here, and it's not going to be as easy of a trade. But in my view, based on valuations, energy stocks can continue to trade really well. Now, I don't know if they're going to outperform the rest of the market the way they have this year, but I think there's a long-term 2023 to 2024 structural trade in U.S. energy equities that will produce good results.
Rebecca, more short-term in nature. Of course, it's smack in the middle winter season. Storm activity is starting to pick up. Are you seeing any crowded trades right now in the commodity space?
You know, that's a good question. No, because I'll tell you this, in crude, and I'll speak to crude specifically where I'm most knowledgeable, positioning has been decimated over the last 2 weeks. We've seen open interest fall. We've seen net long length in the market come down significantly. So if anything, I think positioning is very light and set up for a kind of a coiled spring rally if we get any kind of positive data point. Maybe, and I did see retail buying the USO ETF last week. Maybe we're seeing retail start to nibble, which can be a little bit of a contrary indicator. But honestly, the products, the crude oil positioning seems pretty light to me. Maybe in nat gas, you have some over positioning there. But as far as I'm concerned, I don't see a super crowded trade in the commodity right now.
That's very interesting. We didn't get as much into the Russia side of the equation. So just briefly and sort of in layman's terms, if you can, what is the risk to the up and to the downside as we go into 2023 coming from Russia?
Yeah, so the risk for 2023, the risk to the upside is that Russian flows are impacted by the next round of sanctions that take place in February. These are product sanctions, diesel and gasoline that are flowing into Europe. Those are around 800,000 to 1 million barrels. Those are much harder to find alternative buyers for. So there is a chance that when those sanctions kick in, Russia will be forced to shut in some production and remove some supply from the market. That's the really big catalyst. That would create upward trajectory for crude. On the other side of that, though, and I think it's good to highlight the downside, we've seen softening of sanction language going into each round of the implementation of sanctions. And should language soften around that and the EU kind of make provisions to allow products to continue to flow to the market because they don't want to see these price spikes, you could see, I think the setup for February is people expect 1 million barrels to come offline. And if that doesn't transpire, we could have what happened just after the December 5th sanctions where you have this letdown. If that doesn't happen, I tend to think we will see a disruption of around 500,000 to 700,000 barrels on the Feb 5th sanctions, just because Europe has been pretty unified in wanting to push forward with their sanctions packages.
Rebecca, it's always great to catch up with you and good to look ahead to 2023. Thank you so much, Rebecca Babin of CIBC. Happy holidays, Rebecca.
Thank you. Have a great day.
Thanks. Coming up, Sears' hometown is declaring bankruptcy. Saz has got his take next. We are seeing markets sell-off accelerate here as we are not even 30 minutes into the session, but the Nasdaq leading declines down by 1.9%. And guys, I'm taking a look at the Wi-Fi Interactive and seeing tech is doing the worst today. Information technology, the XLK down 2.4%. The XLC, communication services, is also down, but you got materials in that mix as well. XLB and the financials. Obviously everything is down. If you look at the Nasdaq 100, Saz flagging the Tesla shares.
Look at that big rally in Tesla,
here.
Jolly Julie. Wow, look at that, ripping higher.
Yeah, after a lot of selling going into today, but obviously a lot of other pretty dramatic selling happening right now.
Coming off of its 52-week lows as well. Netflix, yeah, down almost 7% right now, and that actually is one of our top 5 trending tickers right now that people who are on the Yahoo Finance website and app are looking at. Also, Novavax, that one is number 6 on the trending list. That's down by about 19% here on the day too, tracking that as on a day where more largely we're seeing some of the major averages down by about 1.25%, for the Dow down by about 1.7%, for the Nasdaq down 2% right now.
Yeah, Novavax, I believe, announcing a share sale, and that's what's putting pressure on the shares. It's interesting that on the trending tickers, a lot of them are in the green. People looking for winners today in a very down market.
Plug Power up almost 2% on that list, striking a deal with Nikola of all companies.
Oh, interesting. Now that's paired those gains, but still getting a little bit of a bid.
Looking for a bright spot out there, everyone.
Yes.
Guys, coming up, the top 10 things for VCs in 2023. We're going to speak with Tusk Venture Partners, Bradley Tusk, next.
Good morning, I'm Brian Sozzi here with Jolly Julie and business class Brad. Selling pressure has returned to markets after a more hawkish than expected Fed meeting on Wednesday. Right now, we're seeing really losses accelerate across the board. The Dow is now down almost 650 points. The S&P 500 also, the S&P 500 and Nasdaq also in the red. All right, here's what we have coming up for this hour. VCs and crypto. We'll talk with one venture capitalist on his view of crypto in the wake of the FTX debacle. In the final few shopping days, with the latest retail sales report out and coming out pretty disappointing, we'll get a look into how the sector is faring this holiday shopping season. And bullish on Taco Bell. One analyst is hot on Yum Brands following its key investor day earlier this week, and we have the details. Brad, over to you. I know you like Taco Bell.
I love tacos. Let's take a look at the Dow Jones Industrial Average. Right now, it's down by about 1.9% as we're taking a look at that past 2-day performance, down a little more than 2%, but 640 points in the red right now, just about 31 minutes into the start of trade here on the day. Of course, this coming after that retail sales data this morning, and as the market's really pricing that in. It's interesting because typically bad news would be a good news indicator for the market, because that would really signal what action the Fed may take in at least kind of pulling back in the course or the speed at which they've gone on their rate path policy. But since we've already got that decision out yesterday, market's really digesting that retail sales data this morning and moving it lower on the day for the Nasdaq as well. That's down by about 2.4% right now. S&P 500, that's down a little more than 2%. Let's take a look at some of the sector activity as well. We were negative across the board. I expect that to still be the case. It indeed is, so we'll keep it moving. XLK is down by about 2.8%. Let's take a look at the Nasdaq 100. You've got a lot of lake red in the equation as of right now. Apple's down 3% right now. Alphabet, Alpha Google, Google, whatever you're calling them at home, call them red by about 3.5, 3.6% right now.
I like Alpha Google.
Alpha Google.
I like the new name. And Tesla, I have to notice on that screen, has paired its advance now.
But still in the green.
Still in the green, but barely in the green here as we head further into the session. It is interesting how negative the sentiment here remains as we are taking a look at the sell-off that's going on following the Fed meeting yesterday, following that retail sales data today coming in.
Hawkish meeting, and the market is adjusting to that. I think, though, that lift up in the rates, really a negative thing here.
Yeah, it seems that way. Some of the other stories that we are following right now, documents unsealed Wednesday in FTX's U.S. bankruptcy proceeding revealed that just before the company's implosion, one of FTX's insiders turned on Sam Bankman-Fried. Yahoo Finance's Alexis Keenan is here now. What are we learning through some of these documents, Alexis?
Yes, so this all came in a hearing yesterday in the U.S. filing bankruptcy court, and it has to do with FTX Digital Markets, right, which is not part of the U.S. bankruptcy. It's not one of those 100+ entities that's involved here. However, what's interesting about these documents and is causing quite a bit of contention between the Bahamas and the U.S., Bahamas regulators and U.S. new management for FTX is this. So there was a letter that was unsealed in the Delaware Bankruptcy Court that came from the executive director of the Bahamas Securities Regulation Authority. And what this executive director said to the law enforcement in the Bahamas, and this comes on November 9th. So timeline is right before the U.S. bankruptcy filing. What she ends up telling law enforcement is this. She says the commission understood Salome, and this is the co-CEO of FTX Digital Markets, Ryan Salome. He supposedly told these regulators in the Bahamas about an unsanctioned transfer of money. And he says this is, and let me step back a minute. This is the executive director writing to law enforcement. She says, co-CEO Ryan Salome, the commission understood him as advising the transfer of client assets in a manner contrary to the normal corporate governance and operations of FTX Digital. She says, put simply, that such transfers were not allowed and therefore may constitute misappropriation, theft, fraud, or some other crime. So what we're seeing here is really the first time that an insider at the company, this Ryan Salome, that he is going ahead and saying that there was a transfer of funds from FTX Digital to Alameda, and sorry I left that part out, it's to Alameda, all of these transfers that have been of such concern with the FTX implosion. So he's saying that this was not sanctioned, and so this then spawned a urging by the securities regulator to law enforcement to launch a criminal investigation immediately, is what she was looking for.
So what's interesting here, too, is the overlap that at least the Bahamian authorities had talked about early on in their first statements about where their own overlap with the U.S. securities laws as well, where that would actually push them to continue their own investigation. So is there any kind of, in that overlap, joining forces of the two entities, or is this just going to be kind of separate finding of information, finding of details as we move forward from here?
So there are tremendous problems, tremendous contention that we're seeing now playing out between the Bahamas authorities and the entities that were there and headquartered there versus the U.S. authorities and the entities that are included in the U.S. bankruptcy. The Bahamas authorities, they want to see this liquidation. They have liquidators appointed as of Tuesday. They have filed a Chapter 15 in the U.S., which is meant to get coordination with the U.S. courts when you have an international entity that's also involved with U.S. entities needing to figure out, how to apportion the money when this all shakes out. So the Bahamas authorities, they say that they reject the validity of these U.S. proceedings. You have John Ray, the CEO of FTX, testifying before Congress this week, saying that he does not trust Bahamas authorities. In this court hearing yesterday, the lawyers for FTX's U.S. bankruptcy, they again told the judge, we do not trust Bahamas authorities. So there is a lot of discord between these two, between the international entities and also the management of FTX U.S. now. So just that is, I think, really the highlight and what you take away from yesterday's proceedings and the documents that we're seeing here. Bahamas authorities saying, well, these documents show that we were working on behalf of the favor of all of the entities involved, but the U.S. is saying, no, we don't think so. So we'll have to wait to see what evidence more they have to substantiate that. But at this point, the lawyers maybe now subject to an evidentiary hearing in Delaware to try to shake all of this out. One more thing I want to point out is that in this letter, Salome supposedly told the Bahamas regulators that there are only 3 people capable of making this kind of unsanctioned transfer from FTX Digital Markets to Alameda. And those people would be Sam Bankman-Fried, Nishad Singh, who was the director of engineering for FTX Digital Markets, and also Gary Wang, co-founder of FTX.
Yahoo Finance's Alexis Keenan keeping a pulse on this developing story. Thanks so much.
Sure.
Appreciate it. Everyone, keeping in the same frame here broadly, regulators and policymakers are now looking to build legislation from the destruction left behind after FTX filed for bankruptcy. Joining us now to lay out tech's most anticipated regulatory battles for 2023 is Tusk Venture Partners co-founder and managing partner, Bradley Tusk. Bradley, always a pleasure to speak with you and good to see you. Absolutely. Yeah. So first and foremost, if we can, from a VC perspective, where did venture capitalists go wrong in evaluating FTX and really doing any due diligence? Because there was clearly a lack thereof.
Right. I mean, I think you almost asked and answered the question in the same sentence, which is people got so caught up in the moment. They felt such a need to show that they were in crypto too, that they were just throwing money at SBF without really doing the kind of diligence that they should. And not only that, throwing money at him and then taking a lot of credit for it publicly. We saw Sequoia do that, especially in their own internal magazine. And look, it's a big black eye for Sequoia specifically, but for venture generally. But I do think also there is a real distinction between FTX and the rest of crypto. And one final thing, because the venture market was so crazy over the last couple of years, it wasn't just crypto. People were writing checks without doing diligence in every sector, in fintech broadly, in health tech, transportation, climate, whatever it is. I would be on a call with a founder and then be told if I was interested, I had to submit a term sheet 20 minutes later. And my answer was usually no, I'm not going to do that. But I think a lot of other VCs did.
Bradley, this is something I've been asking as well, because we've heard from other folks, there's a baby bathwater situation here where people are sort of throwing out everything crypto, not everything crypto is bad. But at a certain point, does it matter? If crypto is all about perception, the value of an asset is what people ascribe to that asset. If people are not ascribing value to that asset, does it matter if there's actually sort of intrinsic value there?
Yeah, a few things. So one is, in a weird way, the FTX thing has gotten so bad that it's actually helpful for crypto, because when it was just like, here is a company not complying with regulations, not taking things seriously, and causing all of this damage, that really casts aspersions on the industry overall. Now that here's a Bernie Madoff-like figure who committed deliberately a massive fraudulent scheme, it actually kind of separates it out from the rest of the sector in a way. So weirdly, the worse it gets for Sam Bankman-Fried, the better it gets for the rest of the sector. But overall, look, I think that one thing that we could and should do, and I've been calling for this for a while, would be, one, let's have a ratings agency that can actually rate different tokens and say, these are more secure investments, these are less secure investments, and base some of that on intrinsic value. So for example, Bitcoin, because there is a limited supply, has some intrinsic value. Ethereum, because applications can be built on top of the blockchain for it, has intrinsic value, but most tokens do not. And the second would be, I would love to see a world, and the feds would have to waive antitrust provisions to do this, but the top 10 exchanges get together and say, these are the 20 or 30 tokens that we're going to trade, and everything else are effectively junk bonds, and we're not going to touch them.
You have a close pulse on DC and broadly within the overlap of policy as well as some of the more innovative kind of business ventures that are out there as well, and specifically within blockchain. And you and I have discussed that in the past. So specifically, in terms of understanding blockchain technology, do you believe that there is enough of an understanding in Capitol Hill for there to be regulation, at least starting there and then making its way into crypto?
Well, right. So no, I mean, I think that if we actually asked every member of Congress to define Bitcoin and blockchain as two separate things, what percentage gets that right? 10, 5, something like that. So no, they're not particularly well informed. And I think it is really important for them to understand that, look, some cryptocurrencies may have intrinsic value and may really still be worthwhile. Others may not. But blockchain as a whole, it's plumbing, right? There's a better way to transmit data from point A to point B. And there are certain functions that make more sense on the blockchain. So for example, in the wake of the Taylor Swift Ticketmaster fiasco, ticketing on the blockchain that is much more transparent and auditable, it's something that could be pretty appealing, right? Anything where you're tracking records, whether it's a DMV or property liens or anything like that, makes sense for the blockchain. But as a VC, one thing that I have found is I get pitched every day with every conceivable idea for the blockchain, right? Uber for the blockchain, Airbnb for the blockchain. And one of the questions I have to ask myself is, does the blockchain actually make the product better? In this case, sometimes it does. So in the case of like the tickets, I think it really could. In other cases, it's just hype and doesn't really make a difference.
Bradley, we've talked to you in the past about Tesla and what has been going over there, but there's been this view that's emerged, at least on Wall Street, that Elon Musk shouldn't be running Twitter and running Tesla because he's now doing harm to Tesla. I mean, do you share that view, and what do you think he should be doing here from a leadership standpoint?
Well, look, I think the first thing is you shouldn't make decisions based on trying to get attention for yourself. He bought Twitter for all the wrong reasons. I really think he just woke up one day, was feeling badly about himself, needed a dopamine hit. And in the same way that we might buy a latte or even a car to make ourselves feel better, he bought Twitter. And then clearly he tried to get out of it for months. But it's a problem for two reasons. A problem, one, because it's probably a pretty terrible investment. But number two, Tesla in some ways isn't unlike crypto, right? Is Tesla a really great company that produces a really good car? Absolutely. Is Tesla worth 5 or 10x what General Motors or Ford should be, or 3x what Toyota should be? Of course not, right? So much of Tesla's share price is based on hype, and it's based on kind of just the pixie dust that Musk is so good at putting out there, that in a way, whenever he risks puncturing that image, it doesn't just reflect on Twitter, it reflects on Tesla, it might reflect on SpaceX and everything else that he's doing. And so I think he's taken risk for his entire portfolio.
It's so interesting, the common thread between all of this stuff, which is easy money that is now going away, right? That fueled a lot of this, both on the venture side and in the public market side. There are so many things that were hyped, that were invested in, that we're now seeing they're going to be happening later than expected or not happening at all. What should we be watching for sort of next? Is there a next shoe to drop that hasn't been exposed yet in this process?
Yeah, that's an excellent question. I think the good news is the stuff that probably was at the margins has now started to be flushed out to a certain extent, but it's really valuations more broad, right? So I think what happened is a lot of venture capitalists said, I really just want to live off the management fees that my fund generates. And so if 2% of my total fund size equals X, and that's what I need to pay my bills every year, that's all I really have to do. And as a result, the funds got way too big, right? So you have a $600-700 million Series A fund, you can't write $2 or $3 million checks in that case. You got to write $10 million checks, $20 million checks, which means the valuation has to be inflated. And then all across the chain through every successive round, all the way through growth equity, everything remains inflated. It finally hits the public markets. And then the markets usually correctly slash the value by 60, 70% because what they got wasn't reflecting reality at all. And so I think now the next shoe to drop will just be valuations are way too high, and they're way too high in part because VCs were benefiting themselves on the inside, often at the expense of their own LPs.
Tusk Venture Partners co-founder and managing partner Bradley Tusk. Always good to see you. Happy holidays. We'll talk to you soon.
Thanks so much for having me. Have a great holidays, guys.
Of course. Let's do a quick check on the markets here. Really seeing this session get increasingly ugly. Right now, you're seeing the Dow down close to 700 points. The S&P 500 and Nasdaq also in the red. Really seeing sell-offs across really some big tickers here across the board. But again, you're seeing that sell-off accelerate here in the wake of the Fed's decision yesterday, which many market participants viewing a little more hawkish than they expected. All right, before we head to break, let's shed some light on shares of Yum Brands. Analyst notes are rolling in following the restaurant chain's Investor Day on Tuesday. This one from the team at Bernstein caught our attention. Says the team, while the goal of adding 100,000 plus units in the long run seemed ambitious, we left the meeting marginally more positive and gained incremental insights on the secret sauce that Yum is deploying, including category education and greater brand focus at Taco Bell, a stronger franchisee base at KFC and Taco Bell, and repositioning of the brands to attract a younger and more digital customer base, notably over at Pizza Hut. Coming up, a new crackdown on TikTok. Julie is back with a look at that, plus more of today's top headlines next.
Let's get down to business now with a look at the big stories in finance and beyond today. The Biden administration reviving a program from last year that would offer COVID-19 tests for free during the winter. It's part of an attempt to help stave off an expected winter surge in the illness as the weather worsens and conditions exacerbate the spread. The program would see rapid self-administered tests available to order through. Listen to this one, covidtests.com. Note it down, covidtests.com. They're expected to be delivered in the days before Christmas. Clamping down on cyber attacks, the U.S. Department of Justice announcing the results from a sting on 4 higher cyber attack services. It saw 6 arrested and 48 websites seized. Those websites could be used to launch attacks designed to slow or even bring down other sites entirely by flooding them with bogus requests. The websites were sometimes disguised as legitimate tools meant to stress test websites, but were used instead for harassment, extortion, and criminal mischief. And the Senate has passed a unanimous bill that would ban federal employees from downloading or using the social media app TikTok. That legislation, which of course still needs approval from the House and to be signed by the president, it comes as fears continue to grow over cybersecurity, surveillance, and influence by the China-owned social media site. And we should mention, by the way, a similar bill passed the Senate in a previous Congress, but it never moved forward in the House. So we'll see what happens this time with TikTok. Saz?
New year, new start, but maybe not if you're big tech. An overall gloomy outlook for the market has caused companies to pull back on ad spending. This as regulatory scrutiny grows over tech's influence. This combination creating pain points for tech, including massive layoffs. Joining us now, Yahoo Finance tech editor Dan Halley. And Dan, hit us with some optimism. Is there any reason to be optimistic about tech?
No.
Okay, there we go.
Yeah.
Segment over.
I'll see you later. Yeah. No, there's some reasons to be optimistic. I think the one that the experts I spoke to said is, look, they're still making great products, right? There's no negative products really that tech is coming out, unless you consider, metaverse headsets a negative, which we'll have to see. But the big thing is we're still going to be dealing with layoffs most likely into 2023. Just because the big ball drops in Times Square doesn't mean that this pain goes away. Along with your hangover, probably it won't go away as the ball drops. But there's also going to be issues as far as regulatory scrutiny from, we're looking at the FTC trying to stop Microsoft's acquisition of Activision Blizzard, trying to break up Meta into multiple parts. We have potential DOJ investigation into Apple and their App Store service. And then we have Google obviously facing off with its own antitrust suit. And then, there's going to be the Supreme Court looking at Section 230 of the Communications Decency Act and with regards to how companies that host online media recommend content through algorithms and whether or not they can continue to use those, whether or not they're still shielded underneath Section 230. So there's all of these continuing issues. And, we can talk about how the ad market hasn't recovered at all yet. We can talk about how Meta is still just being absolutely demolished as far as year-to-date stock price goes. I mean, you want to talk about a dog, woof, woof, baby, that is not good. None of this is going to change just as the new year rolls around. But as I said, they still make cool stuff. So there's that.
Right. They make cool stuff, but they're all on the hardware front going to be embattled with the relationship with the consumer at the end of the day. And on a household front, if you do see that discretionary spending continue to dry up a little bit more, what does that mean and signal for some of these big tech companies?
They're already kind of, in hot water just because people bought, so it comes to PCs, right? A lot of us bought computers, PCs during the pandemic. I'm not going to go out after 2 years and buy a new computer. I mean, I would because I'm, that's like video games and I'm a dork. But if I was a normal person, I would not. So there's no reason to go out and buy one. People, may already have already bought phones. Phones sales were through the roof during the pandemic because people just wanted to get something new. That's the device that they were looking at, I would say like 90% of the day as they were laying on their couch in their basketball shorts. Again, just me. But I think that that's something that, people aren't necessarily going to need to go out and buy. The big deal that we're looking forward to, I think, is really what Apple's going to be doing with its headset. And that's supposed to come in the second half of 2023. It's Apple, so there's obviously a huge amount of interest. Look at Meta, though, and their Meta Quest. It's not exactly a massive seller. I don't know necessarily if people are going to be going for a high-end headset. My stance on headsets is still, people get surgery so they don't have to wear glasses. I don't think people are going to want to shove something on their head for, hours and hours at a time.
It's a niche. It's a niche
I mean, look, 3D TVs were a niche, and where'd they go? Oh, wait, they disappeared. So, I just still don't know if that's necessarily where things are going to go. Augmented reality, on the other hand, that seems pretty cool.
Yeah, we'll see, hopefully.
Dan, a lot to keep tabs on. And of course, within tech, there is a lot that could make its way into our houses, but may not in the future too. Dan, appreciate the breakdown and the outlook. And guys, coming up, we're going to speak with the CEO of Walker & Dunlop on what to expect from the commercial real estate market in 2023. That's coming up next. Welcome back, everyone. As inflation continues to ease, our next guest says consumers should expect this to lead to more opportunities in the market, with data predicting rent increases of 4 to 6%. Walker & Dunlop CEO Willie Walker joins us now. Willie, great to have you here with us this morning. All right, so what opportunities specifically should some consumers expect?
Well, I think we started to see some optimism about what might happen with rates prior to the announcement yesterday with the inflation report day before yesterday. I will say that Chairman Powell did a good job of trying to take away any optimism that came in with that inflation print during his press conference yesterday, and the markets are reacting to that. We had thought that maybe there was 50 basis points this time, and then we'd get maybe a 25-25. Chairman Powell yesterday talking about another 50 basis point increase, I think has put a lot of downward pressure both in the tech sector as well as in the real estate sector. But there are lots of people like Jeremy Siegel at Wharton who say that the Fed's not going to have a choice, that the numbers are going to move materially, and that will give us some rate stabilization into 2023. In our world, unlike the single family world, where rates need to come back down for single family mortgage originations to pick back up, in our world, we really need rate stabilization. Owners of commercial real estate have been watching the Fed rate increases and rates go up precipitously over the past 6 months. And what we need is for some type of visibility into where the Fed is going so that people can make a decision about what type of financing to put on their property. And then you'll see cap rates adjust and you'll see transaction volume begin again.
So are you, I mean, maybe not a freeze, but what has deal activity kind of ground to a halt right now as people await that kind of visibility?
So you're sort of in between. Anyone who has discretion right now is either going with floating rate debt because they think rates are going to come back down in the kind of medium term, or they are on the sidelines waiting. What has not happened is you don't have a distressed market right now. So what you're not seeing is fire sales to try and raise capital. Been a lot of focus on Blackstone's BREIT and about the BREIT and what the BREIT has been doing as it relates to redemptions. They put up the gates as it relates to redemptions on the BREIT as well as Starwood's SREIT. But both of them have those protections in place so that there isn't sort of a run on the bank. And I would think because of their performance that many long-term investors stay in those vehicles. But yes, transaction volumes are down precipitously over clearly a year ago. Q4 a year ago, you remember the 10-year a year ago today, I think was at 144, 145. So we've got 200 basis points added to the 10-year right now from where we were a year ago. And in an industry like commercial real estate that is so debt-driven, that is invariably going to slow down transaction volumes.
Willie, are you planning your business next year on the assumption that the Fed cuts rates at some point?
Not cuts. All we need is stabilization. So if the chairman had come out yesterday and said, we see inflation abating, we got 50 now and we'll take a look at where we are, I think you would see a lot of investors step back in from a commercial real estate standpoint saying, I can start to see how much my cost of financing is going to be. Cap rates will adjust and I can start to transact again. I would say that yesterday's press conference probably kept a bunch of investors on the sideline. But as I said previously, there's no assumption in our business plan that they have to cut in 2023 for us to see volumes pick back up.
Willie, finally, I want to ask you about rents and what you see happening for rents. Obviously, that's one of the major areas of CPI that we've been focusing on, that the Fed has been focusing on. Do you expect to see any kind of stabilization there or even declining rent rates?
So we've seen rent growth fall off significantly, but we still have plenty of rent growth. I had Ivy Zelman of Zelman, which is a fantastic research firm, which just in full disclosure, Walker & Dunlop owns, on my weekly webcast last week. And I was actually very surprised that Ivy and her team still have a projected nationwide rent growth number of north of 5% for multifamily in 2023. I would have thought that number would have collapsed down to 2 to 3% rent growth on a national basis. Clearly, there are pockets where rent growth is going to be higher than that and others that are going to be lower. Many of the Sun Belt states that had massive growth over the past couple of years are going to see an easing of rent growth. And a number of markets where there hasn't been a whole lot of supply coming in, such as California, are going to actually see healthy rent growth.
What we've also seen is platforms like Airbnb trying to get more into the rental space. And I think one of the recent announcements really signaled that in the long-term stays that they are seeing, that there is some opportunity for them to kind of play more of an intermediary role in the market. What does that signal to you and your company when you do see a major platform play like that on the technology front, trying to get more into the rental space and the rental market?
You know, I'm asked constantly about competition. Walker & Dunlop, which is a firm of only 1,500 people, goes head to head with JP Morgan, Wells Fargo, and CBRE every day. And for a long period of time, everyone says, how are you going to compete? And we've been able to compete. So the technology companies, while I do not dismiss them whatsoever, have had a very difficult time penetrating the commercial real estate space. Single family, they've done quite well, whether it be Zillow or some of the other platforms that have come into the single family space. But when you're talking in the commercial space where there's a huge amount of institutional capital and the decisions to either buy or sell a property or to finance a property are tens of millions of dollars, we find that the diligence that is needed and the human interface that is needed to make those transactions actually happen has not been disintermediated by technology. And so while there's always we're investing in technology a lot, as are those three big banks and services firms that I've just talked about. But for new entrants, Airbnb is an incredible platform. But I do believe that people go to Airbnb to figure out whether they're going to go on vacation and not necessarily where they're going to rent their next property.
Willie, good to catch up with you. Willie Walker, Walker & Dunlop CEO. Thank you.
Thank you.
One stock we want to check on that we're watching this morning is Novavax. Those shares are slumping some 20% after the drug maker proposed it will sell up to $125 million in stock along with the $125 million convertible debt offering due in 2027. This comes after a difficult year for the stock. It is down by over 80%, in fact, about 90% in 2022, even as it did have some advancements on products, but has not helped the shares. Well, the final shopping days of the holidays fast approaching. How are retailers faring? If you judge by this morning's retail sales numbers, not great, but we'll talk about it more next.
Retail sales for November came in lower than expected. That comes as inflation continues to weigh on consumers who look to be entering next year with even more debt. Here to weigh in on the state of retail this holiday season is BDO National Retail Practice Leader Natalie Collar. Natalie, good to see you here. This was a really disappointing retail sales report. Is the read here from a retail standpoint that these retailers will enter next year with a lot of unsold inventory and potentially even more discounts hitting malls in January?
Brian, you're absolutely right. So there's really no surprise about the fact that November was as it was. We did have a couple of good days. So obviously we saw that Black Friday was pretty strong compared to prior year. Cyber Monday was strong compared to prior year. However, I think what we need to do is really look at the holiday season as a whole. The holiday season this year started, I think, even earlier than it ever has. The holiday season started way back in October, perhaps even when Amazon had their second Prime Day. So I think we need to, in order to evaluate the holiday season, we really need to look at it as a whole. Consumers started spending back in October. So it's no surprise that sales are not where we would expect them to be in November.
So across some of the categories that we did see weakness in this retail sales report, is there any bounce back in sight given the consumer environment right now has sentiment that continues to also dampen sentiment and across the discretionary categories that continues to be extremely weak, and people are just not buying a new Peloton bike or not buying some of that sport and fitness equipment or even durables to refurbish the kitchen even?
So consumers are in a tough spot right now. So if you think about where we are in terms of inflation, although this month seems to start stabilizing a little bit, we've had several rounds of interest rate hikes. Gas prices have been high for quite some time, although they are starting to come down. But consumers have spent all their money on gas prices. And as you mentioned, the increase in consumer debt is at an all-time high. So consumers' wallets are now more tighter than ever, and they are concerned about what's going to happen in 2023. I think overall 2023 for retailers, for lots of retailers, is going to be challenging, at least the first half of the year.
Natalie, is there anything retailers can do in this environment, right? Are they just sort of powerless against these macro forces, or are they things they can do at the margins to help improve traffic and sales?
So it's a good question. And I think a lot of this depends on strong execution. There's three things that retailers can do. It's nothing new, but executing on it appropriately and timely is going to be the secret. One is customer engagement, and engaging with your customer from customer acquisition, customer retention. Two is revisiting your cost infrastructure. And we've seen a lot of retailers already doing that by cutting headcount. And I think last but not least, and certainly very important, is surrounding inventory, and that is around supply chain. You want to make sure that you as a retailer are ordering the right inventory at the right price, and then making sure that it comes in at the right time. So those are the three things that retailers need to consider. Nothing new, but strong execution is the critical part now.
And Natalie, while we continue to track all of that, there's an undercurrent that continues, is a rise in inventory shrinkage across retail. A lot of this related to various retail crimes. How serious is this problem becoming, and what are retailers doing to just make it stop, because it is really biting their profits?
Absolutely. So we are seeing an uptick in retail crime, and it's not the usual petty theft that we've seen over the years. That's significant. What we're seeing now is more thoughtful crime, and people are stealing in order to resell. And it's certainly hurting the bottom line. Lots of retailers, as we've seen over the last couple of weeks, have announced that they're either going to increase prices or they're going to have to close stores. And that comes on the heels of considering the cost of the additional security that they would need to have, the cost of lost merchandise and replacing all of that. It's certainly a concern, and I think that it's going to be something that retailers are going to consider going into 2023. Do they have to keep those stores in those questionable areas with lots of crime open?
Natalie, thank you so much for your perspective and expertise on this topic. Natalie Cutler is BDO National Retail Practice Leader. Thank you.
Thank you.
Got to check on markets real quick, because we do have this sell-off that continues to accelerate. The Nasdaq now down by more than 2%, down 2.4%. The S&P off almost 2%. The Dow off about 614 points, or 1.8%. The acceleration to the downside here after we got some pretty disappointing data today on the retail sales front. We'll continue to track it. Coming up next, more on retail. Retailer Esprit, it's making the trek back overseas, returning to the U.S. after its decade-long absence. I certainly have fond memories of this brand. We're going to speak with the company's CEO next. After over a decade of shuttering all of its North American stores, Hong Kong-based retail giant Esprit, it's making a comeback in the U.S. The brand recently launched a pop-up store in Los Angeles. It has plans to open stores in New York. This comes as the company reaches profitability again after 5 years of losses. And joining us now is Esprit CEO William Pack. William, thank you so much for being here. As I mentioned in the tease, I'm old enough to remember Esprit and have fond memories of it. It was a huge brand. Catch us up on what happened to the brand and the company, and now the comeback.
Hi, thanks for having me here. So this company has been around for about 54 years from San Francisco, but over the last 25 years, it's been moving around. It's mainly been based in Germany, in Europe, over the last at least 10 years, because the last time Esprit had a store here was 2012. So this is a big comeback because we're opening, as you mentioned, a pop-up in LA. Yesterday, launched the pop-up in Soho, New York City, actually. And we're actually moving the global creative office to New York City. So we're creating a whole new division here.
How do you cut through all the clutter out there in apparel land, meaning you have a lot of competition that maybe wasn't around 10, 15 years ago? How are you approaching from a creative standpoint?
So this is where it's very interesting. It's originally a California coastal brand, California Cool. We're modernizing that, turning it into a metropolitan outdoor brand, designed, created, photographed in New York City, so that it's now going to be known as a New York City brand, which will go global from here and re-expand again.
How important is the margin profile when you are looking at even that expansion in bringing back into the U.S. Based on the types of styles that will sell through, the inventory that you're moving through as well, and then just being able to make sure that the consumers are prioritizing purchasing with Esprit as a viable option versus this fast fashion environment too?
Yes, so Esprit is not fast fashion. Esprit was one of the original eco-friendly, sustainable brands. So taking that DNA from the heydays in the 80s and 90s, bringing that forward, we're doing a retransformation of the company. So there's a rebranding coming out next year, a repositioning, so that the messaging will be very clear to all consumers what we represent and what we sell. And it's quite a happy brand, so people are really looking forward to this coming out.
Yeah, it definitely has from what I remember, colorful, happy kind of brand. I also, of course, have in my brain the Esprit logo, and I wonder what role that is going to play. I mean, we sort of went away from logos for a while, but now with the resurgence of 90s fashion, we've seen some return of logos as well.
I think the logo is a good representation of what the brand stands for and the history of it. So we're going to be sticking with the iconic Esprit logo. Little modification in colors, but it's going to stick to that because we're noticing that consumers nowadays are looking up to brands as a very trustworthy thing to look up to in a world of turmoil and things like that. So this is a very stable thing we want to stick with.
Take us through your supply chain. Any problems? Has supply chain shortages cleared up at all? And what are you seeing on pricing just for garments?
We've seen about a very large supply crunch about 7 months ago across the world in shipping and also logistics. But because we diversified over the last year and a half during our restructuring, we were able to avoid a lot of these bottlenecks. So our inventory flow from there is actually on track with what we were planning. So given that, I think we're well positioned for our re-entry next year.
What would you say the average demographic is, or the age of the consumer that you're going after right now in different markets may look like?
I think that this brand transcends different demographics in terms of age and geography, so that we're not actually targeting a specific age group because this resonates throughout the spectrum. And we're trying to make it a very, very, very wide demographic.
Esprit CEO William Pack, thank you so much for joining us here on set, and safe travels to you as well. I know you got a long flight ahead.
Thank you.
Absolutely. Guys, coming up, Sears Hometown is declaring bankruptcy. Sazi's going to share his take next.
It's the story that never ends. The other Sears is now in financial trouble, much like its parent company. Yeah, there's still some Sears out there. Sears Hometown. It's a franchise-owned unit of Sears. It's filing for Chapter 11 bankruptcy. Brian Sozzi, of course, has followed Sears for many, many years. Many years.
I can't believe I'm still covering the Sears story. It's just, this stuff just won't go away, but yet here we are. So here it is. Sears Hometown Stores, they were a spin-off in 2012 from Sears. Back then, Sears was very strapped for cash, so they spun off this asset, also sold the Craftsman brand a little bit later on, but nonetheless, they spun this off. And now, Sears Hometown, which was purchased by Transformco, that was a holding company that ultimately held a lot of these Sears stores post their own bankruptcy. Sears Hometown now declaring bankruptcy. This chain was about at 100 stores currently operating, down from 700 stores just 3 years ago. They were largely owned by franchisees. Now, I went back and just familiarized myself with the Sears Hometown concept, and I recall writing back in 2012, one of the key problems with the brand is that they essentially relied on inventory from Sears. That's where they got all this garbage that didn't sell at Sears got dumped into the Sears Hometown stores, and franchisees got a lot of great prices on this stuff. Well, Sears basically now no longer exists. So if you cannot get inventory from Sears stores, you cannot stock these Hometown stores with any form of goods. And the problem with Hometown was that they never solidified or got relationships with other vendors to get other inventory in these stores. So they were just really just feeding off the carcass that was Sears. So no shocker to see this chain ultimately go under. In the bankruptcy filing, noting $50 million in assets and $50 million in liabilities. And another little fun fact here, Eddie Lampert, the longtime CEO.
I was waiting.
Yeah, well, he is almost a 38% holder in Sears Hometown. I'll say it again. I've said this before. Really will go down as the worst CEO I've ever seen in my career. I could probably be doing this till I'm 95, and he will still be the worst CEO I've ever seen in my career. But look, this chain will ultimately go away, as will the rest of the Sears stores. Handful of them left open across the country. No surprise to me.
Yeah, continues to be a tough environment for department stores, even more broadly. But Sears, and what we had seen in terms of the decline over the years, eventually just having to offload square footage that they had, and I mean it was tumultuous in the final days of Sears. And so, what's the take on this one?
My take is this. Drum roll, please. Sears will just be a Wikipedia page, and there's the Grinch. Really,
I thought it already was.
It is a Wikipedia page. It will continue to be added, and it's depressing. You know, I have a Sears by me in Long Island that is closed, of course, but you still see the building there. Nothing has gone into it. It's just sad. It's sad to see this stuff, Julie. It's sad.
Well, you know what else is sad?
Yeah.
The markets today. If you're a bull, sorry to continue the bummer. Jolly Julie can't bring positivity to the markets today. The Nasdaq is down by 2.6% right now. All three major averages are indeed trading lower because guess what? Retail sales are down. Empire manufacturing was terrible. Inflation is still going up at a lower rate, and the Fed's going to keep raising rates.
So you like Jolly Julie? I was scared. I wasn't going to call you that. I didn't want you to yell at me, but you like it. You're good with it. You're okay. Can I use it going? I was going to go business class.
I'm wearing my Jolly holiday sweater today. I don't know if it's going to last beyond today.
I'll tread carefully.
But for today, I will take it.
I want you on my good side.
Coming up next, Akiko Fujita and Rochelle Akufo will continue our coverage of the sell-off with an economist from Mizuho Americas to give us more perspective on the economic picture and what's going on today with this selling. I won't be back tomorrow, but these two gentlemen will. Have a great day.
Now you're gonna get, I'm gonna save. Welcome to Yahoo Finance Live. It is 8 a.m. on the West Coast, 11 a.m. on the East. I'm Akiko Fujita with Rochelle Akufo. Here's what we're watching at this hour. The great disconnect. Markets are falling over themselves, trying to second guess the Fed. Today's retail sales show a slowing economy and stocks decline. So are investors calling Powell's bluff? We're going to be asking Mizuho's Steve Rasciuto for his take. From speculation to practical use, crypto bull markets have come and gone, but could the foundations of the next one be even stronger? We speak with PitchBook on whether opportunities on the horizon offset the lack of clear regulation. And battle lines drawn. President Biden knew what he'd get from a Lina Khan-led FTC, but has the agency's antitrust agenda bitten off more than it can chew? Microsoft's deal for Activision is in the crosshairs, and our panel is going to be discussing later this hour.
That's right. Well, before that, let's take a look at how the market is faring an hour and a half into the trading day. We're seeing all three in negative territory. The Dow near the lows of the day there, down almost 2%. We're seeing the S&P 500 there also down more than 2%. And the tech-heavy Nasdaq there down about 2.5%. And we're seeing when you look at some of the mega caps in the Nasdaq that are really weighing it down, Apple, Google selling off at the moment. A little bit of a bright spot, though, when it comes to Tesla. Also want to take a look at what we're seeing with the Treasury market as we're seeing still trying to digest yesterday's announcement from Fed Chair Powell. You see the 5-10 and the 30 all down today. The 5-year down just very slightly, about 0.25%. The 10-year down 1%. But look at the 30-year down about 1.5%. Well, while the Federal Reserve raised interest rates, central banks around the world followed, including the Bank of England and the ECB, both raising by 50 basis points. And Akiko, we do tend to see something of a coordinated effort from central banks, but this is it's a very different sort of recovery that we're trying to look at now.
Yeah, no question about it. I mean, you could argue that central banks still very much in a hawkish tilt, although we are seeing those rate hikes continue, but at a slower pace. We saw something similar, as you pointed out, with the ECB today, 50 basis points hike as opposed to the 75 basis points we saw before. But ECB President Christine Lagarde making very clear, just as we heard from Fed Chair Jay Powell yesterday, they are going to continue on this rate hike cycle because the credit markets simply haven't tightened enough to be able to see inflation come down. A few things to note what she said. She says we have made progress over the past few months, but we have more ground to cover. We have further to go. And obviously, Rochelle, we've been watching kind of the inflation print here in the U.S. with that CPI number that came out earlier this week. Same thing over at the ECB. When you look at the Eurozone inflation numbers, they have come down, but they're still at very elevated levels when you continue where central banks want to be, which is at 2%. We're still well off the mark there.
And especially keeping in mind the additional pressures, the cost of living crisis, and then, of course, the energy crisis stemming from Russia's invasion of Ukraine. So interesting to see a lot of domestic issues that a lot of these central banks are trying to deal with while also having this global coordinated effort as well. But now, of course, we did hear from Jay Powell yesterday. So let's just remind ourselves of what happened with this basis point hike and his approach going forward.
We continue to anticipate that ongoing increases will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. In addition, we're continuing the process of significantly reducing the size of our balance sheet.
Well, the Federal Reserve slowed down the pace of its rate hikes yesterday, and while Fed Chair Powell struck a hawkish tone at the press conference, are markets set to believe his message, especially based on what we're seeing now? Well, for more on the market action from yesterday's Fed meeting, let's bring in Yahoo Finance's Jared Blickery to break this down for us. Hey, Jared.
Hey there, you might remember this graphic from about 24 hours ago. We had two possible choices, Powell being hawkish or dovish. Guess what? The hawkish tone prevailed. So this comes with a slower to pivot. So in other words, rate hikes are going to continue longer than expected. And then risk assets that include stocks, commodities, crypto, those are going to be flat to down. And in fact, they did sell off pretty handily yesterday. Let's take a look inside the market action. Now, this is a 3-month chart of the S&P 500. I also said 3,900. That's about where we are right now, to 4,200, 4,150, 4,200, huge kind of neutral area until we punch through this level or to the upside out of this box here. Probably going to be not going to have a lot of directional input here. But once we do break the range, probably going to get some momentum off of that. So let's take a look at some of the sectors that were hardest hit yesterday. Powell spent an inordinate amount of time talking about the hot labor market. I think it's clear he's going to engineer a recession, but considering how far the Fed was behind the curve, they had to do 4 75 basis point rate hikes in a row. Considering how far they were behind the curve, you have to imagine when reality is going to catch up. Now, the market is dialing in, the market is pricing in a Fed rate cut by the end of the next year. And the Fed officials, according to the SEP yesterday, they were indicating that they're actually going to be raising the rate additionally to 5.1%. So there's a huge disconnect between what traders think are going to happen and what the Fed says is going to happen. That's showing up in weakness here. This is today's sector action. Tech taking it to the downside, followed by communication services. That's where you're going to find the Meta ticker, and as well as some telecommunication tickers. Materials also down 2.5%. These are the underperformers. And you take a look at the 2-day, you can see communication services, tech, materials again, and also financials. So let's begin with financials. Banks very sensitive to the yield curve. Didn't like the message yesterday. So this is over the last 2 days. You can see, well, this is the energy market. Let's take a look at the banking sector right now. JP Morgan down 2%, Bank of America and also Wells Fargo down 3%, Morgan Stanley down 5%. And then you take a look at what happened with the semiconductor sector. Now, I think this is key here because you're not necessarily seeing this with software. Semiconductors, chip stocks in particular, very levered to the cyclicality of the economy. So we got NVIDIA down 7%, Taiwan Semi down 3%, AMD down 7% as well. So the winners and losers here are becoming clear, and it's mainly the losers to the downside.
So Jared, what does this all mean heading into 2023? What can we expect to see at the start of the new year?
Well, first, interesting tidbit from the press conference. Powell probably not going to move the goalpost on that 2% inflation target. There was some speculation around that. He left it for a later date, a much later date, pretty much tried to take it off the table. But I think the writing on the wall is clear here, Akiko, that the Fed is going to engineer a recession. And the question is, how much damage has the aggressive rate hike schedule that they've already engaged in? How much is that going to hit the economy in the new year? And how is that going to change the Fed's evolving view of the economy? The analysts, the macro analysts I'm talking to and looking at, they have a pretty dim view of the economy, and they're looking for shorting opportunities in the major markets into early next year, notwithstanding whatever might happen in the next few weeks with the Santa Claus rally. So that's big picture stuff.
We're still holding out hope for that Santa Claus rally.
Yes.
Jared Blickery, thanks so much for that. Well, let's keep the Fed conversation going with Steve Rasciuto, Mizuho America's chief U.S. economist. Steve, let's try to digest what we heard from Jay Powell yesterday and start with where we are on the rates. The Fed now projecting median forecast between 5 to 5.25%. You say the terminal rate's going to be even higher.
That is 100% correct. I think people are missing one important aspect of this business cycle, which is it's not like the last four. The last four business cycles are what I refer to as credit cycles, in which with the Federal Reserve raising rates created or caused an asset allocation mismatch to erupt into a broad-based credit or liquidity crunch. There is no evidence that the economy has any of those preconditions for a broad-based credit crunch this time through. And that means we're back to the behavior of the Federal Reserve and the economy that we experienced prior to 1990. And the economy will prove to be much more resilient than the bond bulls want to believe. And this is the difference between the two analyses. If you don't have a credit crunch, and I do not believe you will have one, you wind up having a significantly higher rate of Fed funds rates and held there for longer before you have an onset of a recession that can bring inflation down back closer to the Federal Reserve's target.
And we know that the rate hikes tend to get the bulk of the attention, but you're also focusing on what you're seeing with the way that the Fed is using its quantitative tightening. And you're saying that this could disrupt market liquidity. Break down your case for us.
Well, again, I don't think market liquidity is going to be broken down. I think the point here is in the last 4 business cycles, liquidity did break down. The 1990 cycle was a commercial real estate debacle. The 2000 recession was a merchant power debacle. The 2007 number was the subprime debacle. The 2020 period was the COVID debacle. All of them resulted in squeezes in liquidity of the economy that caused the economy to go into a recession. This time through, we don't see any of those mismatches. Nobody is short funded. And the Federal Reserve taking liquidity out at the pace they're doing while we had $5.4 trillion having been injected is not significant enough to really upset the apple cart in the time period in which the market is anticipating. So I think the market is off base here. I don't think this concept that, the Fed is bluffing. I think the reality is the market is based on a historical scenario that is no longer a relevant scenario.
So, Steve, the fact that you're saying we're not likely to see a liquidity crunch, what does that suggest in terms of the resilience of the economy to be able to ride out these aggressive rate hikes coming from the Fed? We've heard so many people say a recession is inevitable come 2023. What do you see?
Well, I think a recession will be inevitable in 2023, but we have to get the higher interest rates, and we're going to have to hold them there for much longer. You're not going to be in a period where the economy comes crashing down and the Federal Reserve reverses policy very, very quickly. You're going to have a very long, shallow recession environment. So there's always going to be the question, are we in a recession? Are we not in a recession? We may not know we were actually in it until after we're out of it. And that could take a full year. So I think in that environment, you wind up with the interest rate cycle, the curve staying inverted for longer, and actually probably going to a much steeper inversion. From 1990 forward, we weren't able to get to an inversion of more than 50 basis points. And in fact, in each of the cycles from 1990 to 2020, the point of inversion became less and less before a credit crunch developed. We're already past the 1990 50 basis point spread, and we're heading down to the 80 basis point area, and you're probably going to have to get into the 100 to 150 basis point area and hold it there for some time to have a recession unfold. There will be a recession, but it's going to require an inverted curve for longer and higher levels of rates to do it.
We know investors watching for all the signals. A big thank you to Steve Rasciuto there, Mizuho America's chief U.S. economist. Thank you for joining us today. All right, well, shares of Tesla in focus this morning as recent filings show that CEO Elon Musk has sold over 20 million shares of the electric automaker. This in addition to other large sales of stock in November, August, and April. He's now sold roughly $23 billion in Tesla shares. And I know this is not welcome news for a lot of Tesla followers and Tesla bulls. We've seen a lot of backlash coming through online, especially on social media, Akiko.
Yeah, not welcome news. Putting it pretty lightly there, Rochelle, when you think about the reaction to this sale. And let's go back to what we heard from Elon Musk back in April, because that was the time where he said that we're no longer selling any additional Tesla shares, or I think he said we're not planning to sell. Since then, we're talking about a sale of 22 million shares Monday through Wednesday. We're talking about $3.6 billion raised. All of this, of course, we don't know exactly why he sold the shares. The speculation is that he needs the money to pay down the debt from his acquisition of Twitter because there are concerns he can't meet that interest payment. There's a tweet right there from Elon Musk back in April. No further Tesla shares planned. Now that he has sold additional shares, we have heard some of the most bullish analysts who have been very bullish on Tesla as well, Elon Musk, coming out and saying that, simply that there needs to be something that Tesla does. Ross Gerber, of course, a frequent a guest on our show, saying Tesla should announce a buyback immediately, stop the dilution from Elon's sales. It also allows the company to take advantage to the low share price Elon has now created. Dan Ives, another voice who has been quite bullish on Tesla, also weighing in on Twitter yesterday, saying self-inflicted issues from Musk around Twitter continue to plague the Tesla story and investors' frustrations building. Another Tesla stock sale fuels the black cloud around this story. So, there you have it, Rochelle. We've been we talked about this at the time of the acquisition, how much of the distraction around Twitter would spill over into Tesla. SpaceX, obviously not a public company yet, but other Elon ventures. And you could argue we're seeing that right now.
And it's certainly one thing to be distracted, have your attention elsewhere, but when now what you've purchased for Twitter is now affecting your other businesses like Tesla, we knew Tesla shareholders were sort of bracing for any sort of potential impact here. But I want to draw your attention to Leo Korguan. He's the third largest individual Tesla shareholder after Musk himself and Larry Ellison. And he describes himself as a Musk fanboy. So he's been rooting for Musk. But he tweeted that Elon abandoned Tesla and Tesla has no working CEO, adding, Tesla matters. Elon is a mere hired hand. He's our employee. Tesla is a 19-year-old ranked 4th with 2.4% allocation in the S&P, not a baby, and soon to be the biggest. Elon was the proud father. Tesla has grown up. An executioner Tim Cook-like is needed, not Elon. The idea of separating Elon from Tesla, I think, would be mind-blowing. There is this culture of personality that comes with Elon Musk and the trust there. So to see the third largest shareholder in Tesla coming out that strongly, I mean, that's a big warning sign.
Yeah, I mean, you're right to point that out, that Elon Musk is a brand in his, himself. And so what he does in terms of Twitter, what he says about Twitter also affects the Elon brand that also includes Tesla. When you're talking about the stock itself, we should point out since the beginning of this month, it's down nearly 20%. We saw the market cap yesterday close below $500 billion for the first time in 2 years. So no question we are seeing a bit of a pullback there in terms of Tesla stock. But again, worth noting, we don't know explicitly why he sold the shares. The speculation is that it is about Twitter and the debt he has to pay down as we continue to see some of the bleeding happen there. Advertisers pulling back, a number of changes on the platform as well. And I mean, who knows? A year from now, we could be talking about this disruption that happened before the major turnaround around Twitter. I mean, I don't know. Rochelle, I'm done talking about where this platform is going because it feels like every week it is a different story. But with that said, Tesla firmly in focus today because of the concerns around distraction over at Twitter. So we're going to continue to watch that. The shares hitting a 52-week low today. Well, let's take a quick look at major indices as we continue to see this stock sell-off. Some of that coming through as a result of disappointing retail sales numbers that came out this morning. Of course, the sentiment feeding through from the Fed and Jay Powell comments yesterday as well. The Dow's now down 2.2%, the S&P 500 down 2.5%, and the Nasdaq, the biggest laggard on the day, down 3%. Well, coming up, Trojan horse or red herring? The Senate backs legislation banning TikTok on government devices, and yet another move in the ongoing back and forth with Beijing. We talk apps and fight back next.
The U.S. Senate has passed a bill that bans federal employees from downloading or using TikTok on government devices, a move that comes in the face of growing national security concerns around the social media app. And we know there's been a lot of action here by individual states. We know that North Dakota and Iowa joined a growing number of U.S. states in trying to banning TikTok that's owned by ByteDance, and they're doing this from some of these state-owned devices, saying that perhaps some of the information that's collected could be passed on to the Chinese government. This does seem to be something that has bipartisan support, though, Akiko.
It has, and this is something that we've heard for a few years now. It was back in 2020 that we saw the military ban the use of TikTok on all devices. So we're talking about military, Coast Guard, I mean, all inclusive there. So it has kind of been moving in that direction. We should point out, this is past the Senate. It still needs to pass the House. It needs to be signed into law. So it's not finalized yet, but it is about these persistent concerns around where exactly the data in TikTok is being stored. Now, we've heard from the company over and over that data of American users are stored not in China, but over in Singapore, outside of the mainland. But the concern continues to be from lawmakers, to your point, on both sides of the aisle, saying that, there could be a potential backdoor here, that how could TikTok, which is owned by ByteDance, resist any kind of request coming from the Chinese government for data of American users. And this is really just the latest step. But, you could argue that this has been a constant issue that's been raised, but we are still far from a full-blown ban. And what we've seen is lawmakers trying to chip around at the corners here, this just being the very latest.
Indeed. I mean, the fact that they're still taking this action during a lame duck session, it does show that they're at least prioritizing it at the moment, because we know that other than national security concerns, there were concerns about its impact on teens. So from a lot of different aspects, you have a lot of lawmakers sort of jumping on this same bandwagon to really crack down on TikTok. Whether it goes beyond state devices, whether we might start seeing perhaps employers saying, look, if it's a national security concern, maybe some of our employees shouldn't have it on their phones. I don't know if it'll go that far, but certainly if it's a national security risk, that is an open possibility.
Yeah, I mean, keep in mind that there's still a CFIUS investigation that's been opened. I mean, this has been going on for more than a year, so plenty of investigations that are happening, but still far from a full-fledged ban here in the U.S.
Indeed. Well, we're going to take a break here and have a quick look at what we're seeing with the major indices as stocks are continue to sell off. You see the Dow there now off more than 720 points. The S&P there down more than 2.33%. And look at the Nasdaq there, down more than 2.8%. They're losing more than 300 points on the day. All right, coming up, keeping the faith. Confidence in the future of the crypto space has been more than knocked by the implosion of FTX. But does the data tell you to keep those diamond hands steady? We'll discuss next.
Welcome back to Yahoo Finance Live. Doing a quick check of crypto right now. We are seeing red arrows across the board. Bitcoin down about 3.5%. Ethereum down 5%. Bitcoin now just at 17,452 there right now. Recovering since obviously the FTX collapse, but still below that $20,000 handle. This is the 7-day average of open interest for Bitcoin perpetual futures has dropped 40.3% from the start of November, according to data provider Crypto Compare, citing one of the most closely watched indicators of trader sentiment on Binance's market-leading derivatives exchange. Binance certainly in focus there, Rochelle, because of what we have seen play out this week. Nansen now reporting roughly $3.7 billion being withdrawn from the platform there. We have since heard from Changpeng Zhao, CZ, the CEO founder, coming out and saying that if you think this is going to sink Binance, you simply don't understand our financial position. But it is about questions around what is now the largest crypto exchange by default, or was even before the FTX collapse, but certainly a lot of eyes on that one.
I mean, and we know that we heard from Kevin O'Leary. He was talking about, Binance essentially having a global monopoly now with FTX out of the picture, and sort of suggested that Binance was a bit nefarious in sort of outing FTX and the issues that it had. But obviously, the first thing that Binance wanted to do, what CZ wanted to do, was say, look, Binance is not that situation. Whether or not people are believing him based on the pace of the withdrawals that we're seeing, I mean, that still remains to be seen. And even when you look at where Bitcoin is at the moment, down from its high of 69,000 last year. We're looking at it now at sub 17,500. And then looking at also with Ethereum, down from 4,800 last year. So obviously people still a little bit shaken, even beyond when you think of what we're seeing with the crypto winter. So really, it remains to be seen what the catalyst is going to be to really turn things around at the moment, Akiko.
Yeah, you mentioned those Kevin O'Leary comments yesterday. CZ responding directly to those comments in an interview with CNBC this morning, essentially saying that it's irresponsible for him to make those comments when he doesn't understand how the books are over at Binance. But worth noting, we did also get some additional developments on FTX. We're learning a bit more about how this collapse transpired. Reports here suggesting that it was an insider. Ryan Salam is a senior executive over at FTX who tipped off Bahamian officials to what exactly was happening in terms of the commingling, as it's alleged, that the funds that were being used from Alameda over to FTX. Or FTX to Alameda, that he was the one that tipped him off. So it's interesting because so much of the focus has been around Sam Bankman-Fried, and yet in so much of the reporting, we have heard about this very tight inner circle that he operated within FTX. And now we're learning, at least according to reports, that one of those senior executives was in fact the one that tipped police off to what was happening internally.
And it's true, as you mentioned there, SBF getting the bulk of the heat. At the end of the day, it's his company, but he didn't do this by himself. So trying to figure out who knew what and when and how much culpability they have, we know that that's going to continue to unfold as these investigations continue. Well, it should come as no surprise that in 2020, the amount of capital invested into crypto startups globally has slowed down, according to a new report by PitchBook, although the total amount deployed is poised to surpass last year's. So did big money get it wrong when it came to FTX? Well, venture capitalist Bradley Tusk was on Yahoo Finance earlier answering that very question.
People got so caught up in the moment, they felt such a need to show that they were in crypto too, that they were just throwing money at SBF without really doing the kind of diligence that they should. And not only that, throwing money at him and then taking a lot of credit for it publicly. We saw Sequoia do that, especially in their own internal magazine. And look, it's a big black eye for Sequoia specifically, but for venture generally.
Well, Tusk adding that there is a distinction between FTX and the rest of crypto. Well, joining us now to discuss VC trends and emerging opportunities is PitchBook senior analyst Robert Lay. Robert, good to have you on the show. So as we know, a lot of people sort of merging everything together right now, the exchanges, the tokens, and crypto itself. What are you making of these developments?
Yeah, thank you so much for having me. Yeah, I mean, what we're seeing, like you just mentioned earlier, there's been almost $20 billion invested in this space this year. And, at the very first, most of that capital was raised at the first 4 months of the year. And then we start seeing a significant slowdown in venture capital funding, starting with the Terra Luna collapse and then even further in October, November. And especially over the last few weeks since the FTX collapse, we see very few deals happening in the space. But still, we see that investors are not invested across the board anymore. We're starting to see more infrastructure investments, a lot more metaverse gaming investments. There's been a huge decline in investments in centralized crypto services like Celsius, BlockFi, wallets, exchanges, crypto on-ramps. All that investors have really shied away and deployed capital elsewhere.
How much more of a slowdown are you anticipating because of the FTX collapse? I mean, you pointed out what happened with Terra Luna. Obviously, that was kind of the first trigger that happened over the summer. You look at that chart we just showed, there's a significant drop from that. But how big of a shakeup do you think comes from FTX specifically?
Yeah, we do believe venture funding will continue to decline well into next year, but we do expect it to bottom out sometime before the summer. We expect it to trend upwards sometime later in 2023, but we're being cautiously optimistic here. There's a few signals.
So it looks like we've lost our connection with Robert Lay there, PitchBook senior analyst. Our thanks to Robert. Unfortunately, we have that connection. We have to let it go. Well, let's take a quick look at major indices as stocks continue their sell-off right now. We're continuing to see those red arrows across the board with the Dow now down 770 points. Well, coming up, another super cycle. Goldman says commodities will be the best performing asset class in 2023, but surely a lot of that depends on what happens in China. We're going to get into that conversation next.
Commodities are king again. Goldman Sachs out with a new report calling commodities underinvested, just as that market continues what the bank says is a super cycle. Commodities are set to continue performing well because of supply constraints caused by things like the Russian invasion of Ukraine, even as capex or capital expenditure is down historically. So some interesting moves here. It's clearly taking this long view. Goldman's saying that people really aren't thinking about the future right now. They're sort of looking at the present circumstances and not really thinking about investing for the long term in this space.
Yeah, commodities the best performing asset class, or on track to be the best performing asset class with just a few weeks left in the year. We're talking about a return of 20%. But I'm looking through these notes, Rochelle. I mean, Goldman is calling for a return of 43%. 43%.
Huge.
In 2023. Specifically, they point to the economic growth that sets a rebound from China reopening. Of course, that's still a big question mark. It hasn't necessarily gone smoothly, although it's been just a few weeks here. But certainly that would boost demand. That would certainly help things in terms of the commodity side. And then that point that you just made, Rochelle, in terms of an underinvestment in CapEx. Goldman highlighting that specifically, that there simply hasn't been that, even as we continue to see divestments from hydrocarbons. So, you know, those two key things, I mean, nobody's going to argue with the fact that this was the best performing asset class this year. But you have to wonder, I mean, how many of those factors all line up going into 2023? Obviously, what's happening between Russia and Ukraine, still a big question mark. That has been a big reason behind the rally we've seen this year. But still, if you're talking about a 43% return, which is what Goldman is looking at, that's a pretty significant upside we're looking at next year.
And as you mentioned, a very big if when it comes to China's reopening. Every day we're hearing about new cases and what the demand might look like. This still hasn't happened yet. The policy about changing zero COVID only just kicked in. We still don't know what it's actually going to look like by this time next year, and if China has the ability to get it under control. So I think a lot of countries are sort of looking at this China reopening story, a lot of hopes there, but we still actually don't have a clear picture of what that's going to look like at this point.
Yeah, I mean, if you're talking about, 3% growth this year, and yet, as we were saying earlier this week, potential projection of 5.5%, at least that's the aim going into 2023. Certainly that would support the case for what Goldman is saying. But as you point out, still a lot of questions about how quickly things ease up and demand picks up over there. To that point, new worries rising over COVID-19 as a new medical study says even the COVID booster shots are not as effective against the dominant Omicron subvariants. Meanwhile, the Biden administration making rapid COVID tests available for free again this winter. Here with more, we've got Yahoo Finance's Anjali Kamlani. Anjali.
That's right, Akiko. As you mentioned, that study coming out looking at the efficacy of these boosters and of monoclonal antibodies against the newest variants that we know are dominant today. 72% of cases now with that BQ1 family. And that is a concern when it comes to new cases, especially in the old and vulnerable. The really good small bit of news here is that boosters remain protective against severe disease and death, especially for majority of the population. So that is the sort of like one shiny moment in all of this. But we already know that monoclonal antibodies have all but been done away with. The FDA saying on November 30th that the very last one that was on the market is no longer protective and can no longer be used against the subvariants BQ1 and BQ11, the two that are combined the dominant force right now. We also know that Paxlovid remains the only treatment available, but it also is only targeted at a subset of the population. Paxlovid also just got a renewal with 3.7 million more courses available, purchased by the U.S. government, and that is in addition to 20 million courses already available. Meanwhile, as you mentioned, new round of at-home tests available for the for residents of the U.S. You can go through that same USPS route to get at least 4 at-home tests available to you. In addition, it's also important to point out that CVS and Walgreens are still providing up to 8 tests covered by insurance right now. So a lot of focus on this is all a focus of the White House's plan to help try and curb a winter surge, which many experts are saying really is still ahead, even though we're already seeing some traces of that right now.
It's certainly worth remembering. I know that obviously talking about COVID has sort of fallen onto the back burner. It's still very present. And as you mentioned, that people need to pay attention with the boosters and the tests available. You also mentioned, of course, in the middle of winter, and of course, there's now also a shortage of cough syrup.
That's right. If you look at the shelves of any of the local pharmacies and retailers, there is a shortage of cough syrup, flu medication, and that's been actually happening for some time. As we know, the rise in cases in RSV as well as flu in the pediatric population had resulted in that shortage. Hospitals were struggling, providers were struggling to get their hands on these for their patients, and now that has bled over in the adult population as we start to see the climb in hospitalizations as well as sickness related to flu.
So really just, that triple pandemic we've been talking about, that triple outbreak, it's happening. And just a reminder to myself, Anjali, to get that flu shot as well. Yes. The one that I have been missing so far. Thanks so much for that. Well, coming up, taking on big tech, the FTC has had a busy year, but there are some high-profile battles ahead. How decisive will the outcome of the Microsoft Activision deal be for the fortunes of Chair Lina Khan? We're going to discuss next. When President Biden nominated Lina Khan to be the next chair of the FTC, it was clear he was installing a big critic of big tech to a pivotal role. Her first meeting took place in public, breaking years of precedent and signaling changing times. In the past few months, the agency has been scrutinizing some high-profile deals, filing a lawsuit against Microsoft in an attempt to block its takeover of Activision Blizzard, and looking to stop Facebook parent company Meta from purchasing fitness app Within. Are the battle lines ahead too little too late, or just about time? Joining us to discuss is Rebecca Allensworth, Vanderbilt University law professor, and also with us is Charlotte Slayman, Public Knowledge Competition Director. Charlotte, let me start with you because, there's something I've been wondering. We expected Lina Khan to be aggressive in taking on this role, but what do you see as the downside risk in the FTC moving forward on such high-profile cases? What happens if they don't end up victorious in these cases?
Well, there are a few different ways to lose a case, right? It could be, of course, I think that they have presented really strong complaints. And so we are mostly focused on the upside benefit of bringing these cases. But if you lose, you can lose small or you can lose big. Letting the merger go through or achieving a settlement that isn't as strong as you might have hoped for are some disappointing ways to lose. But another goal of bringing these types of cases is to clarify and improve the law. That effort can also lose. So we could end up with antitrust law being in a worse place than we started.
And Rebecca, you say that basically in the case of the Microsoft potential merger and with Meta as well, that these can be very hard to win, these sorts of antitrust cases. Why is that? What are some of the factors that make it so difficult?
Well, both of those mergers are essentially vertical. They're not mergers between two companies that are currently competing head to head, selling the same products in the same market. And for years, antitrust has been interpreted, especially the merger law, to be about side-by-side competitors. So Kroger and Albertsons would actually be a good example of a head-to-head horizontal merger. But as for the tech ones, we know that a lot of mergers and a lot of very anti-competitive mergers happen in a vertical relationship. And it's just a hard case to make out. And I think it's very purposeful that Chairwoman Khan and the FTC is going after these kinds of edgier cases.
Yeah, in the case of Microsoft and Activision, Rebecca, I mean, how strong is that case? That's been an interesting one to watch because in many ways, Microsoft has been able to sort of elude that public criticism, at least, while those like Meta as well as Google, Alphabet have taken the brunt of the hit.
Yeah, I mean, in my circles, we talk about the big four, but really it should be the big five. Microsoft deserves to be in that conversation along with Google and Apple and Amazon and, of course, Facebook, Meta. How meritorious is the suit? The biggest problem they're going to have is the fact that it's vertical. However, there is increasing recognition, not just at the FTC, but in policy circles, at Congress, that these vertical relationships can be very, very damaging to consumers. When somebody controls not just the platform, but the content that's going on the platform, that can be really bad for consumers.
And Charlotte, to Rebecca's point, it does seem to not just be a policy shift, it really does seem to be a holistic approach to enforcement in this space. What do you think in terms of this going beyond just merger enforcement? What is the end game here?
Yeah, I think it's really important that this includes more than just merger enforcement. I was also really heartened to see the FTC's Section 5 statement talking about how they intend to bring strong cases against ongoing anti-competitive conduct in a variety of industries. What we're doing with merger enforcement is just trying to maintain the status quo level of competition and prevent the losses of competition. But we're already dealing with a very uncompetitive environment. So I do want to see the FTC doing more, bringing those conduct cases. And as Rebecca mentioned, it's incredibly important for Congress to get involved here. So I have also been really heartened by Congress's interest. We're hearing that senators are angling for antitrust legislation to go into the omnibus that Congress is trying to get done before the end of the year. That's how we're going to actually advance pro-competition policies, and that's what we need as well.
And Rebecca, I know you wanted to weigh in there as well. What's your take?
Well, I agree with Charlotte. And I think another thing that's worth mentioning is, she was talking about winning big or losing big. One way that you could lose small or maybe, win and lose is you lose the lawsuit, but you raise attention to these problems in a way that makes the political actors a little bit, it sort of smooths the path for them to pass the legislation. So I'm glad that she brought up the congressional angle too. And I think we could see that being a part of this. The other thing I'll say about merger law is that, the FTC has a lot of authority over merger law, and maybe that's why we're seeing them being aggressive here. But even though it's different areas of law, monopolization, agreements, mergers, the policies and the analysis is very similar. So if you're able to make changes in merger law, those might spill over into the other areas of antitrust.
Charlotte, last question to you. We make so many of these comparisons between what's playing out now and what Microsoft, for example, went through in late 90s, early 2000s. And the story that has emerged from that time has been that, Microsoft fell behind on search. It was about other competitors coming into the market, mainly somebody like Google, who was able to merge as a result. If it is about increasing competition, have we actually seen that competition increase as a result of at least the threat of some kind of lawsuit being brought forward by the FTC?
So I do think companies are on notice. It's been very clear that Chair Khan is interested in aggressive antitrust enforcement. It's been very clear that Congress is interested in aggressive antitrust enforcement and even expanding the antitrust laws. And I think the question now is just how specifically that's going to happen. So it's not at all surprising to see that may have been impacting companies' decisions. We're also seeing antitrust enforcement and new antitrust laws abroad. Already, some of these big tech companies are changing their policies in response to the Digital Markets Act in Europe. And so we may start to see some benefits from that. But ultimately, I am still very concerned about the level of competition that we have today, which is not enough. And so we are going to need some real action in addition to the impact that the broader conversation is already having.
Well, a big thank you to both of you for joining us with your insights. Rebecca Allensworth, Vanderbilt University law professor, and Charlotte Slayman, Public Knowledge Competition Director. Thank you for joining us this morning. All right, coming up, we'll take a look at major indices as stocks sell off their session lows, but still in negative territory. You see the Dow there, though, now off more than 840 points.
A new year means a new start, but maybe not if you're big tech. An overall gloomy outlook for the market has caused companies to pull back on ad spending. This as regulatory scrutiny grows over tech's influence. This combination creating pain points, including massive layoffs. Another issue facing the sector is Section 230, a law created back in 1996 to shield internet service providers from defamation suits. That's now coming under increased scrutiny. Joining us now is Yahoo Finance tech editor Dan Halley. Dan, I feel like we've been talking about changes to Section 230 for a while. What do we expect come 2023?
Yeah, it's been a a long time since we started talking about this. And, I think the big deal here with 2023 isn't going to be coming from any kind of changes in Congress. It could come from the Supreme Court. There's a case that's going to be heard. It's Gonzalez versus Google. And essentially, this has to do with the algorithms that power user-shared content. So, for instance, if you're on YouTube, you get a video that shows up. It was posted by another person. The algorithm says that you might be interested in it, and they're going to then provide it to you. It has to do with a terror attack that took place in France. The family of an American who was killed there is suing Google, basically saying that the algorithm helped to indoctrinate some of the terrorists that were involved in that attack. And they want to see if Google still gets shielded under Section 230 when it uses an algorithm. So this could be a major change, because if you think about the likes of obviously YouTube, Facebook, Twitter, TikTok, Snap, anything that you can think of as far as social media goes, they use algorithms to drive who sees what on their platforms. And, if they do end up saying that this isn't shielded, this particular case shows that algorithms aren't protected under Section 230, it could throw that entirely out the window. And then how does Facebook, or Meta, however you want to refer to it, then go ahead and show you content that's provided without the algorithm? Look, it's what makes TikTok TikTok. Facebook, Meta, they're plowing tons of money into algorithmically driven content. So we'll have to see how this shakes out at some point this year or next year.
And as we were just talking with our guests in terms of this push for more scrutiny when it comes to antitrust, how do you see that playing out next year for tech?
Yeah, look, antitrust is going to be one of the biggest stories alongside Section 230, just because we have obviously this ongoing Microsoft, Activision Blizzard kind of deal that the FTC is trying to stop, as you and the prior guests were talking about. But then we also have a potential investigation of Apple by the DOJ looking at antitrust. We have Google's antitrust issues. We have Meta's antitrust issues. We have Amazon's antitrust issues. And all of these companies are facing the same kind of scrutiny as far as their power over the markets that they compete in. And so I think this is going to be something that could come to a head in 2023. We've been talking about this since 2020, but this is at a time where now we have the suit against Facebook with the FTC. We have Microsoft and Activision Blizzard. They're being investigated by the EU and the UK competition authority. And then we have the FTC here trying to block that deal. So I do think that we're going to get a lot of shakeout as far as antitrust goes for the tech market throughout 2023. It's going to be a big year for them, and whether or not they're able to hold on to the kind of power that they've accumulated over time or not is really the question that I think is going to be answered.
A big year for tech and a busy year for you, it looks like. Looking ahead, Dan Haley, as always, thanks so much for that. Let's do a final check of the markets. As we've been pointing out, an ugly day on Wall Street right now, with the Dow now dipping to session lows here, down about 800 points. We're talking about 2.3% decline there. Tech, the one we're watching very closely here, with the Nasdaq down more than 3%. They are one of the biggest losers on the day. Communication services, another one that's been declining. Of course, we're going to be watching those yields very closely as we continue to see that yield curve invert. That does it for Rochelle and I in the 11 a.m. Eastern hour. We've got much more to come here in Yahoo Finance Live. Keep it right here.